Good morning. I'm David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. Welcome to day 2 of the 10th Annual Municipal Finance Conference. We're pleased to co-sponsor this with colleagues at the Rosenberg Institute of Global Finance at the Brandeis International Business School, the Olin Business School at Washington University in St. Louis, and the Harris Public Policy School at the University of Chicago. Today, we have 4 papers on recent developments in the muni bond market, and then we're going to have a panel discussion that begins later this afternoon. As always, all the papers and slides are on our website, along with a link to the video of yesterday's sessions. We'll resume our conversation tomorrow, Wednesday at 11:30, and I want to call your attention, you can see details on our website, that in an attempt to at least approximate getting together in person, we're going to have 2 open discussion groups, one on state and local fiscal issues and one on the municipal bond market, including advance refunding and other issues. The Zoom links are on our website and you can see them there, so I hope you'll join. At this point, I'm going to turn the virtual podium over to Justin Marlowe, who very kindly agreed to step in for our colleague Rich Reifel, who is suffering from an internet and electricity outage at his house. I guess it's a good thing to have a team of organizers, so we have people as competent as Justin to step in. Justin's a research professor at the Harris School at the University of Chicago. He focuses on issues of public finance. He, among other things, is editor-in-chief of Public Budgeting and Finance. So with that, I turn this over to Justin. And again, if you have questions during the day, you can use Slido, S-L-I-D-O, on the internet, #MuniFinance, and we'll be monitoring those. Thank you.
Thank you, David. Much appreciate that. And thank you to you and to Stephanie and to Helen and everyone else at Brookings for putting together another really, really terrific conference. Look forward to all the content today. A lot of what we have today is from the issuer's perspective. As was mentioned, the theme for today is recent trends in the municipal bond market. And so we'll be getting a lot of really great content, particularly from the perspective of how issuers navigate the capital markets. And that will conclude with a really great discussion with several practitioners, several market participants who are in the market as we speak. So looking forward to all of that. Just like yesterday, we're going to set this up kind of segmented into 2 pairs of papers. So our first 2 papers this morning, we'll have each of them have about 15 minutes to present with 10 minutes for a discussant. We'll talk to both of them first, take a break, come back, then do our next 2 papers, take a break and come back and have our conversation with our issuer panel. So without further ado, when we get to the introducing our first paper here is from Huachi Chen from Notre Dame, who goes by H. So welcome H, and his co-authors Lauren Cohen and Weiling Liu. 15 minutes, welcome, and look forward to hearing what you have to say about the value of call options in the muni market.
Perfect, thank you very much. Let me content from second camera. Let me see here, switch camera. Can you see me?
Sure can.
Okay, perfect. Great. It's really an honor to be here at the Brookings Municipal Finance Conference to present Calling All Issuers, the Market for Debt Monitoring. I'm Huachi Chen, and this is joint work with Lauren Cohen and Weiling Liu. So as this audience knows very well, municipalities issue a large number of public debt, and these debt finance a large number of long-term public infrastructure projects. The interest payments on these debt alone add up to hundreds of billions of dollars per year. And in environments where interest rates can get exceedingly close to the zero lower bound, such as the one we saw between 2009 and 2015, and the one we saw in the past year, managing interest payments and taking advantage of these unprecedented low rates have become paramount to public finance. And fundamentally, in this research, we ask, how well did public institutions actually executed these interest rates? So to be precise, issuers can manage their interest rates through refinancing their existing debts. By executing what's called a call option, issuers can pay off their bonds at a predetermined price and tap into a lower prevailing market interest rate. And almost 95% of long-term municipal bonds are callable after an unlock date. issuers can obtain value by exercising these call options if the prevailing market interest rates are low enough. So for example, if the market rates are lower than the standard coupon rate of about 4 to 6%, then an issuer can call their bonds and reissue the exact same coupon bond flow, cash flows to obtain a premium. Now, the average market rates were between 1 to 3% in the past 10 years. So during this period, the execution of these features was a first order feature in public finance. Now, we're going to examine comprehensively, using all municipal bonds available in the past 20 years, how municipal issuers executed this feature after their bonds became callable. And we're going to look at whether issuers pocketed this premium and how much money was left on the gap. Furthermore, we'll link that large gap in refunding efficacies to the IO of the agents who monitored this market. Now, before I step any further, I just want to mention that scholars in this audience have documented incentives and abuses of using treasuries for advanced refunding even prior to the unlocking of these call options. Given that agents can use advanced refunding, we were really surprised by the significant amount of callable debt that weren't refinanced by the issuers at all. And we view our work as kind of complementary to these prior works on advanced refundings. So let's move on to our results. We find delays in optional recalling across a vast number of characteristics. So both large and small issuers tend to experience delays. Big cities experience as much delays as small towns. And we see differences across US geographic locations, sample periods, bond structure, bond purpose from hospitals to schools to roads. And we observe significant delays across all types of credit rating. So we observe delays in the least safe bonds out there, but we also observe significant lag in the execution of calling of AAA bonds, which tend to have the lowest prevailing market interest rates and are the safest bonds out there. These delays add up quantitatively. So we're going to use a simple calibration to estimate the values lost. And we find that the value lost averaged to about $1.74 billion per year after accounting for issuance fees. The average interest rates in the Muni market is about 5%. So in other words, we estimate that roughly $1 of $100 of interest payments can be saved through optimal refunding. In the second part of the paper, we're going to try to make some progress in understanding why issuers have these call delays. And the most obvious answer is that these delays have something to do with the issuers themselves. So proxies of sophistication and ability, such as issuer size, are definitely correlated with more efficient practices. Larger issuers tend to delay less than smaller issuers. Now, we took our result and went directly to municipalities themselves, including the city of San Jose and various different school districts, to ask them, why do they delay? When we asked them, they snapped back and said, well, just look at their workload. And this is exactly what we did. So we do find that bonds that unlock during times when these authorities are exceedingly busy tend to delay significantly. For example, general obligation bonds delay by an average of additional 2 months if they are unlocked at the fiscal year end. Now, we weren't completely satisfied by the issuer explanation because this is a market where agents actively monitor these debt to supposedly alleviate inefficiencies. And underwriters in particular are incentivized to provide expertise through their investment banking fees. But we show that the industrial organization of this market may not be perfectly suited to drive out these inefficiencies. First of all, the relationships in this market is extremely sticky. Individual issuers use the same underwriters the vast majority of the time, from 57 to 87%. And therefore, even if a competing underwriter is pestering a municipality to call their existing bonds, this issuer isn't really likely to simply jump ships. In fact, it is exactly the issuers who rely on the same underwriter the most that are more likely to delay calling. Issuers who rely on the same underwriter are over 8.1 times more likely to delay. We find that bonds that use regional underwriters seem to have better service than other bonds. And finally, we'll present some evidence for causal interpretation of these correlations. In particular, we show that after the 2009 financial crisis, the municipalities that had used Bear Stearns and Lehman Brothers prior to the crisis has significantly more delays after the crisis than issuers who utilize the other bankers. So if something happens to your banker, it will affect your efficacy. To make a descriptive statement of how different issuers have behaved, we're going to gather up all the data from every corner of the United States on these debt. Our primary data comes from the Emergent Municipal Bond Database. And this is pretty comprehensive because aggregate values outstanding is very similar to time series calculated by other parties, such as the Municipal Security Rulemaking Board. And we're going to remove all abnormal bonds. So bonds with provisions that makes them non-standard for calling, like variable rates, puttable, defaults, or other features. And we're going to remove bonds that were issued by Puerto Rico, Virgin Islands, Guam, or Detroit. We're going to complement this data with historic S&P credit ratings. And for comparison, we're going to join this data with corporate bonds data that comes from the Emergent FISD database. So at any time a bond is unlocked, an issuer is essentially conducting an optimal exercise problem with an American call option. They can call the bond, obtain an implied premium. These premiums are high relative to the value of the bonds if the rates are low. So if the prevailing market interest rates is 0.5%, then you can obtain a very high premium from exercising these options. If the prevailing market rates are low or are high, then you can't obtain as high of a premium. Now, this premium isn't the whole picture because as other parties and members of the audience will tell you, there is a time value of the option, even if the party doesn't exercise. Now, this time value or continuation value is the market value of the call option after the delay, given that it is an exercise. So an agent should only exercise if they obtain a premium that is greater than the continuation value of this call option. So we can calculate the value lost per period from not exercising. That is the difference between the exercise value and the continuation value of the bond. And in this second picture, right, this value lost is only there when there's a gap between the red line, which is the option value, the exercise value, and the continuation value of the bond. That is only when the prevailing interest rates are low enough. So using this method, we can calculate the value lost per period for all the outstanding bonds in our panel. We're going to group all the outstanding callable bonds that don't get called into bins. And for each bin, we're going to calculate the immediate exercise value, the exercise premium of these bonds. And we're going to calculate the model implied continuation value of these options. And we can calculate the difference, which is the difference between the exercise value and the continuation value, which is the cost of delayed exercise every year for bonds with investment grades from the S&P. Okay? And this is what we have. We find that the value lost by Muni issuers generally range between $1 to $3 billion per year in the municipal market. And this is after assuming a 2% reissuance cost. We plot this values out in blue, and we see that it is the highest between 2009 and 2013 before the Muni rates started rising. To kind of compare these values, we could do the same exercise for the corporate bond market, and we plot this in orange. And even though the corporate bonds have much higher values outstanding, roughly $10 trillion outstanding, the estimated value lost per year is much lower. Now, the types of bonds that drive these delays come from all over the spectrum. We can separate bond types using emergent filing codes, and we see that delays are not only driven by any single type of Muni bonds. General obligation bonds that are bonds backed by the full taxing authority of municipal governments are almost as likely to delay as revenue bonds. And about 10% of these bonds never end up exercising their call options, even in the past 10 years, when the market rates are the most advantageous. We see that this variation exists across different states and within states as well. So Texas, for example, has a high efficacy in terms of calling their existing bonds, and we see less bonds being called in the state of California. This variation exists across credit ratings, and as we expect, lower credit rated bonds tend to delay much more than higher rated bonds. And yet we see that there is a certain cross section of AAA bonds that delay their callings by a year or never call their existing bonds even after the unlock date. And next, we're going to just examine the correlations of the ability to delay with various different characteristics. After adding in characteristics including state, year, capital purpose, and credit rating fixed effects, we can only explain as much as 14% of the variation in the delays experienced by various different bond issues. Overall, there seems to be some idiosyncratic effect in this market that makes some issuers exercise much more than others. Next, we're trying to look at issuer effects such as workloads and sophistication. And we do see that issuers are particularly worse at calling their debt that are unlocked near the fiscal year end. Bonds that are unlocked during this time experience higher delays. Similarly, if we interact this workload variable with the size of the issuer, we find that smaller issuers that face high workloads tend to delay the most. And we interpret this as that issuer sophistication and capacity is a factor in driving these refunding delays. And the last part of the paper studies why market participants don't alleviate this gap from issuers. In a perfect world, underwriters and other market participants, such as lawyers, financial advisors, and the voting public are incentivized to decrease the money left on the table by sharing this premium with the issuer. So we examine the individual municipal issuer and underwriter relationships. And what we find is that this relationship are extremely persistent. Issuers utilizing one lead underwriters for the vast majority of their bonds issued. And this is true for all issues. Over 87% of all issues are issued by one lead underwriter. And for issuers who issue much more frequently, so for issuers that issue at least 60 bonds in the sample, the vast majority of these bonds are underwritten by the same party. And we find that this is actually these issuers that utilize just one single underwriter are exactly the same parties that delay their calling. So we can use underwriter persistence as an X variable and try to regress that on whether a issuer delays or not. So we find that issuers who use a single underwriter for the vast majority of their bonds are the exact ones who need the calling of their bonds, the refinancing of their bond the most. Now, these are all correlations, and we can try to provide a bit more causal evidence in terms of interpreting our results. So we can examine municipalities that depended on investment banks that has severe issues during the 2009 financial crisis. So we can exactly examine municipalities that depended on Bear Stearns or Lehman Brothers prior to 2007. After the crisis, these are the exact same issuers who delayed the most. And we don't see any effect if we use any other large investment bank, such as Goldman Sachs. So we interpret this as underwriters and being kind of important in alleviating these inefficiencies, but imperfectly. So we find that, in conclusion, we find that roughly $1.7 billion are lost annually by public issuers through calling delays. These delays come from different dimensions, including bond issues, issuer size, geographic locations, time periods, and various different bond structures, bond purposes, and credit ratings. Furthermore, we find that these delays are consistent with gaps in monitoring. Inattentive issuers tend to delay the most, and that bonds that it uses the largest underwriters are much more likely to delay. So that's all I have. Thank you very much.
Thank you, H. Great presentation and right on time, which is much appreciated. So with that, we'll go right into our discussion comments from Dave Abel from Columbia Capital Management. Welcome, Dave.
Okay, am I live here? Okay, great.
Sure are.
Okay, great. Good morning, Dave Abel with Columbia Capital Management. We're financial advisors. Pairing off with this paper, Calling All Issuers. I want to compliment H and his team for an extensive and robust work product. It's been really a joy to work on this thing from a technical perspective. Municipal call options are a very, very well-traveled subject, as we know. Refunded adjusted yield, when to advance refund, and how to coupon when you do. And a time-honored favorite of competitive versus negotiated sales. These are all very well-traveled topics, but they all orbit around the municipal call option. That's what drives them. But within that peer group, this is the first paper to explore why bonds don't get called and how much that might cost. Knowing the sector as I do, refunding monitors and pitch books are a big part of what we do, and I would think that no CUSIP would go uninspected. So this is my chance to give you a practitioner's perspective. Okay, next slide. Okay, the intuitive findings were demonstrated empirically quite well, but I do want to kind of bookmark here for a little bit later in my comments that the corporate culture differs from the municipal culture in some significant ways. It was a little surprising to me that revenue credits outperformed GO in terms of efficient call timing. And I would surmise that might be because of the enterprise is more specialized. They're monitoring coverage tests. They're involved in rate setting. So the debt structure might be a more central part of the mission statement, and therefore, top of mind month after month. The very sticky underwriter relationships is not something I would have thought of, but as it's been explained, it makes sense. If we have a very low competition or no competition environment, workflow bottlenecks can prevail, and we have a slightly lower sense of urgency. Another issue that I didn't expect would be the case, but they report. So airport, water, and GO would be three different types of credit under the same issuer umbrella. That would be 3 times the workflow of just 3 different GO sales. So that's how I would think about multiple callable issues being a delay factor. In terms of underwriter dominance, general practitioners might have bulk workflow bottlenecks, whereas, and going to Bear and Lehman, being a sticky relationship with a lot of post-exit delay, I think the market climate itself had a big impact on that, market liquidity. So that was a headwind, that resulted in additional call delay. That would just be my perspective. Business focus could be a factor as well. The paper talks about Doherty, for example, owning the Dakotas. All things Dakota, they're very regionally focused and fully up to speed in monitoring what's going on in those 2 states. National dominant bulge bracket firms probably have workflow optimization within the system where they can move flow around and be more responsive. That would make sense from a business model perspective. But the one I thought was most interesting was that competitive sale issuers, or issuers that are known for issuing competitive sales, tend to be more covered by FAs and underwriters. So the FA community is probably the dominant source of monitoring there. External factors driving call delays. I could see from a past life, building a narrative around a structural imbalance or waiting for an audit could add several months to otherwise efficiently calling bonds. Bundling from an administrative economy perspective, I could see holding 2 or 3 call dates in a row if they're closely together to do a single transaction. And one of the things I see a lot, or at least in my practice, is we'll consolidate tax facts. We'll take a long asset life new money transaction and couple it with a current refunding in a way that we can do a restructure and a better outcome than a current refunding all by itself. Okay, next slide. I wanted to see if I could get at this $1.74 billion number. And this was a big pre-conference discussion, most of our focus. And I had 2 major concerns. The first was, were we double counting? And the option value or the refunding PV is how they measure it. But if I was fearful if they do that every test period, we could be adding duplicative values. But as I understand the way the test actually works is that they only add PV incrementally so that not all of, so we don't have multiple refundings counting as a big loss bucket. So double counting is probably avoided. The second concern I had was, are we reflecting yield curve and credit slope accurately? And they do, in fact, use actual data by rating group and by maturity. So this will keep the longer maturities from being overstated in value. So again, to marry up to a $1.74 billion annual loss number, I wanted to see if I could back into some really simple market relationship method to reflect 1.74 billion under different coupon scenarios. So with the par underneath the gross coupon and overtime, I take 1.74 billion and I divide by the coupon, 0.05, 34.8 billion. Now, the refunding bond has to take the place of the refunded bond. So let's imagine that we have annual debt service savings of about 20%. 34.8 billion divided by 0.2 is 1.74 billion. So then I do this for a 3 coupon, a 4 coupon, and a 5 coupon market culture, if you will, versus the 3.8 billion trillion outstanding. And I get 5.76 or 4.6% of the market involved for a 5 coupon, 5.7% of the market not called for a 4 coupon, and much higher, 7.6% not called for a 3 coupon. Again, this is extremely crude, but the results aren't crazy. So we have some complexities here. Replacement optionality, for example, refunding adjusted yield is a topic that Peter Orr's developed quite well. Premium coupons are expensive if not called. Taxable and corporates tend to issue at par, so they're going to be more loss resistance if not called. And importantly, these annual test dates may or may not co-align with bull markets. So we could have annual January test dates, but the bull market occurred in April. Next slide. Ways to mitigate this loss could start with just issuing lower coupons. But there's a trade-off here. So if the bond is called, in this example, 20-year maturity, yield to call is lower with a 5% coupon, 1.31 versus 1.66. If the bond is not called, the yield to maturity is lower with a 3% coupon, 3.31 for the 5 coupon versus 2.44. But there's no free lunch here. Higher coupons can reduce bond borrowing cost over time, but the bonds have to be called to get there. Lower coupons can be safer if not called, but there's a higher floor cost that comes with that. Next slide. Okay, my effort number 2 to get at this from a series of current refundings, actual refundings using actual yield curves, one each year for a 30-year level debt structure. So I created something issued in 1990 whose call starts in 2000 and goes out to 2020. Obviously a very narrow example of how debt might be issued, but it does give me a call date in every year during the test period. So this is a AAA credit plus 20 basis points. The refunding rules are all or none, and if done, I get level savings. I'm looking for a 3% minimum PV, and if I reach that 3% PV and I don't refund, I start the loss clock. So later PV tests are reduced by successive accumulations of prior foregone annual savings. So what happened here? We had 3 silent years because the market didn't deliver value on these 5 coupons. 2003, we got there and we met the test and we start the loss clock. 2004, a year in call delay, was our best year, even though we had a loss year behind us. Post 2008 started delivering us fantastic PVs, you can see later in the list there. But by that time, our refunding had reduced in size considerably and we had accumulated considerable loss. So at the lower right-hand corner, I wanted to see what this example series would cost over time for 5 coupons, 4 coupons, and 3 coupons. 5% coupon, we left 9.4 million on the table. For 4% coupon culture, we left 4.7 million on the table. For a 3 coupon culture, we left 2.4 million on the table, all as expected. Next slide. I want to take this very same structure and try it on lower coupons and lower credits to see if these results made sense. So for our AAA rated 5 coupons, the earlier markets worked best, even though we had absolute higher yields and longer duration. For our lower coupons and lower ratings, we had better value in later markets. At that time, post 2008, we also had much steeper curve slope and shorter remaining refunding duration. But there's a major flaw in my approach here that is a weakness that is not, that the paper overcomes. I'm doing an all or none, refund every maturity, refund none of the maturities. Their method is far more accurate and granular. They go bond by bond rather than series by series. But nevertheless, we have kind of a simplistic anecdote. Lower rated credits and lower coupons reached a goal. That might be the best value to be had. Okay, my wrap-up slide, one more. So this research can inform policy and best practices. But I did say I was going to comment on the corporate culture. There are three key differences that I see. Municipalities are more disparate and multitasked. We have maybe 80,000 municipal credits versus 8,000 much larger corporate credits in the public markets. Municipalities tend to issue serialized structures, amortizations over time that are supported by taxes and user fees. Corporations don't tend to pledge specific revenues. Rather, they use large bullets and they roll along sweet spots in the yield curve, probably on average a shorter tenor than 30 years. Make whole calls are common in the corporate market, so a par call delay is probably far more muted, even considering the size of the corporate market. Municipal markets also have unique features on tax preferences. Being a tax-exempt market, premium couponing forestalls capital delays should bonds ever trade in the secondary market at a discount. So the market preference for premium couponing is very present. We also have remediation for change of use and change of control. Taxable at market rather than tax-exempt above market, non-exercise loss is probably going to be inherently lower just on those cultures. A quick comment on competitive sales. In order to win the bid, we have to reach the lowest TIC to maturity. And that's a measure that cannot assume that the bonds will be called. That inherently drives the offering to lower coupons, and therefore competitive sales may be more delay loss resistance. So some ideas are sort of near and dear to how I think about call dates. These are structuring implications, and I think they're supported by this work. We'll try to position a call date to occur when the yield is most likely to actually be lower. So take a 15-year bond with a 10-year call. When you get to that call, it's now a 5-year bond. So the odds that slope was a big part of driving lower yields is considerably higher. Let's go to the opposite extreme. Let's take a 30-year bond, which becomes a 25-year bond if we put an aggressive 5-year call on it. So in that instance, we're far more dependent on absolute rates actually falling than yield curve slope. So there's a good chance that a very, very long maturity with a super short call will have incomplete development of value. And so that call is probably a target of languishing. Credit enhancement, I tend to prefer to use on par coupons where the yield benefit goes more likely to the whole life of the bond. If I use credit enhancement on a very high coupon, the odds are that that's only to the call date and the pricing reflects that. Non-call is always an option, but we have price resistance and upward pressure on yields. We also have a situation that's very costly to restructure and very costly to remediate. On monitoring and advocacy, I think technology and transparency is a tailwind in tracking. And otherwise, try to synchronize away from the high traffic periods of the year for budget and audit cycles. So that's a well-written paper. I enjoyed working on this, and Justin, I'll turn it back over to you.
Thank you very much, Dave. Appreciate those comments. Certainly very, very insightful from the standpoint of a market practitioner. So thank you for that. We have a couple of questions from the audience, which we can definitely get to. Before we do that, I wanted to just real quick see if H or any of his co-authors had any kind of immediate reactions to any of Dave's comments.
These are extremely helpful. Thank you so much. And there's a lot of comments to get through. So we really appreciate all this roadmap that you gave us. Thank you so much for the next revision.
Happy to do so.
Great. Okay, well, let's get to some audience questions then. So we do have one that came in right away. The question is, has there been any drift over time in the market's covenant stringency that might have led to a non-interest rationale for calling versus not calling? So a question about the role of covenant stringency in the market.
So most of these bonds have option lockups that are 5-7 years ahead of time. So to the extent that stringency drives our value, where it probably doesn't, but it's definitely worth checking. So we do know that coupon payments have come down over time as their interest rates came down. But in terms of covenant stringencies, I'm not sure. So we can definitely check on this.
Perfect. Another question.
If you have a footprint test required and it's a coverage credit and you're not quite there, you could be sort of locked out of being able to execute inside a footprint, and you have to wait for a performance to come back in order to capture savings.
It's something definitely worth checking a bit more on. Yes.
Great. Another question was the advent of the SEC Municipal Advisor Rule taken into account. That certainly might have limited the ability of underwriters to pitch refundings to issuers to some extent. So any thoughts on that 2014 SEC rule?
So in terms of the time series difference, we do see that the value lost peaked around 2012, 2013, and then decreased ever since. So in terms of the time series difference, in terms of value lost, we don't see a dramatic increase after 2014. Whether that causes anything in the cross section, we could check a bit further, but definitely not in terms of just the raw time series difference.
Okay, Dave, anything to add to that?
Yeah, I think we're very careful to provide market general comment and try to be non-particular and non-specialized in a refunding recommendation. So I think for the most part, we've been able to inform, advise, and say, hey, you've got callable bonds in the market, but to turn that into and restructure it this way or do something else would result in advice being given. And so I think we're far more careful about what we say and how we observe than we used to be. But I think that from a monitoring perspective, we're still doing our best to get in front of as many people as we can.
Perfect. Another question from the audience, and that question is, did you consider that issuers might be waiting to call to see if interest rates might go down even further?
I mean, definitely, that is definitely one of the cases for a lot of issuers. If I see that the interest rate is 3% and I think that it might go down to 1% or 2%, I might want to wait. And this is exactly why we incorporate continuation values in our analysis, right? So, the value that we calculate as loss is with the idea that these issuers can exercise their call options and also keep the call options for their future issues. So if they delay, right, if they call their options now, they can ideally have their premium now and also reissue the exact same bonds with another call option, just in case that the interest rates go down even further. So that's how we incorporate that twist into the analysis.
Makes sense. Makes sense. Dave, anything to add to that too?
Yeah, I think that knocks on the door of the refunded adjusted yield analysis, long-term borrowing cost as a result of several subsequent refundings chained together. I think one way that this delay on anticipation of a better result happens is simply that the 3% policy goal is a very old goal, long time ago. That the goal is probably, as a practical matter, at least doubled, if not tripled. There was a time when an 8% PV was just a home run, and now a 25% PV is a home run. So I think standards of performance have raised, and that may very well result in waiting to see what happens.
Makes sense. Okay, before we go on to our next paper, anything else any of the author team or Dave wants to add here? Last chance to chime in before we move on.
I just want to thank Dave again for all the insightful comments. This has been incredibly helpful.
Sorry, I just wanted to add that thank you very much for this opportunity. And I think H answered most of the questions exactly the way I was thinking as well. But I just wanted to add that there are significant time trends that we see in our data, and that's why we have that plot over time. But we don't see any breaks. Those are really good suggestions to look at regulatory changes. We don't see any sharp breaks, at least from this first cut, but we will dig in deeper. And we do have the year fixed effects, so we can look at some of those year by year changes as well. So thank you very much.
Now, this paper was a lot of fun to work on. I appreciate the opportunity. As these guys know, I really put them through the paces. I didn't believe the $1.74 billion, and I really arm wrestled about that. And finally, I think won me over for the most part, especially when we were able to kind of develop some back of the envelope proxies to say, all right, the result isn't crazy. Probably some granularity is deserved in how we approach this, and there's some external factors that we can't account for, but nevertheless, protecting for non-call loss results in loss of value at the outset. That's the coupon discussion. So monitoring and advocacy is probably central to the discussion.
Well, that makes great sense. Well, thank you to our presenters and to Dave for your excellent discussion comments. So moving right along then, staying with some of these same themes around pricing and the role of coupons and the role of option value in pricing. Our next paper is from Guy Davidson and Andy Callaway, and it's titled Par Muni's Subpar Performance. So we'll have Guy present that paper, and then we'll have discussive comments from Steve Winterstein. So welcome to all of you. Look forward to hearing what you have to say.
Start video. Okay, can I be heard?
We can hear you for sure.
And let me go back to, can you see my screen?
Not yet.
That is, I went to share screen. And I don't know why that is the case. So let me go back and see if I can try that again. Share screen. Preview, no, it's desktop 1. Share. Open system preferences. Zoom, yes. There we go. Will not be able to record the contents here. Okay, later. Okay, and are you able to see it now?
Not yet.
I can
Okay.
share it on my end if you can just cue me through.
That is perfect. That's what I was going to ask you to do.
Yep, no problem.
All righty. Well, thank you for the rescue. And let's get started, because I'm going to take up my full first 15 minutes. So good afternoon, I'm Davidson. And Andy and I wrote Par Muni Subpar Performance earlier this year. Today, it's my pleasure to present the ideas, and Andy will join us for the Q&A. But I'm going to present the ideas from the perspective of an institutional money manager. In fact, for the last 28 years, could you move to the next slide, please? I ran municipal portfolio management at AllianceBernstein, and that's a business where we had 50 billion in AUM in portfolios that were managed both for individuals and institutions. Now, to have a successful business or money management business, we needed to offer strong after-tax returns, particularly over the short to intermediate term, say 3 to 5 years. So we were measured and compensated both on our mark-to-market performance, and of course, we had to be tax smart in our realization of gains and losses. But that's all kind of what you would expect me to say, right? As a portfolio manager. But what may be less obvious to you is how tax liabilities in the future can impact municipal bond prices today, and accordingly can impact short and intermediate term mark-to-market performance, which is exactly what we're focused on for our clients. So today's story is about the impact of tax liabilities on par muni bonds and why institutional investors, like myself, at least until the end of last year, we had a very strong preference for premium coupon munis. Next slide, please. Let's start our story today by looking at what municipal investors use as their benchmark yield curve. Now, on the left side of this slide is the benchmark AAA Muni yield curve from a week ago. It looks like what you'd expect a yield curve to look like, right? Yields rise as the years to maturity increase, which you can see on the x-axis. Now, look at the right side of this slide, and here are the corresponding bond prices. And what you see is prices begin maybe a little above par, but they quickly rise to $130 or 130% of par value by the 10-year maturity. What's going on? Well, the benchmark curve for municipals is for 5% coupon bonds. And once you get to the 10-year maturity, they're also callable bonds. And this is in a world today, they're using 5% premium bonds in a world where yields are 1% to 2%. So there's a real preference, and muni investors use premium bonds as their reference curve. You can see also investors' preference for premiums in market indices. If you compare ICE's muni and corporate bond indices, you'll see that the yield of the municipal index is about 1% lower than the corporate yield. At the same time, the coupon on the muni index is more than 1% higher than the average coupon of the corporate index. In fact, the muni coupon is almost 5%. Not a surprise, right? So let's take a step back here and ask ourselves, why would an investor prefer to pay an issuer 130% of face value today to get back 100% at maturity? I know I have lots of clients who've asked that question. But it's a conundrum, right? Unless you know about taxes. And that's to the next slide, please. The answer really is about taxes, and specifically an obscure part of the federal tax code called by muni investors the de minimis tax. So to think about why, let's talk about let's thinking about a 10-year bond that is issued with a 2% coupon and priced at par. Now, if yields rise, the mark-to-market value of the bond falls because the yields are higher. That's bond math, right? The present value of the bond's cash flows are worth less when discounted by a higher yield. But that's not the end of the story for muni bonds. With munis, investors are focused on after-tax returns. So tax liabilities at maturity also must be accounted for. If the bond is bought at 98, the investor will have a long-term capital gain when the bond matures at 100. If the bond is bought at 97, the 3-point appreciation will be taxed as ordinary income. Now, I'm not going to spend much time going over this at the moment, and you can see it in the paper, but here the de minimis thresholds are shown, and you can refer to this later. But the real point to focus on is that muni returns aren't necessarily tax-free, and investors should and will compare investment alternatives on an after-tax basis. Next slide, please. This accounting for tax liabilities at maturity depresses municipal bond prices when they fall below par. Here, along the y-axis are prices for a 10-year bond, non-callable, at different interest rate levels. Now, the x-axis shows the difference between the coupon and the yield. At 0, the bond's coupon and yield are equal. And if you look to the y-axis, the price equals 100. Now, as you move to your left, yields are lower than the coupon, and the price is higher and above par. Now, look to the right. Prices are lower, and the blue and red lines diverge. The red line shows the conventional price-yield relationship where future taxes aren't considered. Now, future tax liabilities are accounted for in the price shown along the blue line. As you can see, the blue line falls more quickly because the next buyer wants to be compensated for your future tax liabilities. If they aren't, they'll simply buy a different municipal bond without those tax liabilities. In short, tax costs increase the interest rate sensitivity of par and discount munis. In fact, in the next slide, please. Yeah, thank you. As this chart shows, the price sensitivity of a par bond changes both drastically and quickly. To bond managers, duration is the measure, price sensitivity to a change in interest rates. If a bond has a duration of 10 years and interest rates jump from, say, 2% to 3%, a bond manager would expect prices to fall by about 10%, which is the product of duration and the change in yields. Looking at the red line here, the conventional measure of duration is pretty stable. That's not the case when comparing or when tax liabilities become part of the picture, and you can see that in the blue line. When a muni bond's price falls below par, its price is declining both because yields are rising and because a future tax liability is being created, a double whammy, so to speak. So par and discount munis have longer durations than conventional analytics indicate, and the impact of taxes are handled by a tax neutral approach. So that's all nice theory, right? Let's take a look at some trades and see how much better accounting for taxes and a tax neutral approach does in estimating the price movements of munis. So next chart, please. Here we went to the MSRB's trade database, and we looked for par and premium coupon bonds with similar maturities and call features issued by the same issue that were large enough to have a history of trades and issued long enough ago so that they had traded over a wide range of interest rate levels. The two bonds I'm showing you here were sold in 2016 by Los Angeles Unified School District, a high-grade issuer. The par bond has a 2% coupon, and where am I here? Yeah, at 2% coupon, matures in 2029 and is callable at par in 2026. The premium coupon bond had a coupon of 5% and matured 1 year shorter in 2028 and had the same call features. Furthermore, they both had almost 80 million in outstanding bonds, and so they had significant trades over time. Now we're going to focus on the institutional trades, which were 1 million and above. And when we looked at those, since issuance, the fives have remained premium bonds, while the twos have covered the spectrum of discount to par to premium due to the changing levels of interest rates since 2016. Now, one more comment. Since simple yields to a benchmark curve are not a good comparison for bonds that have such different call structures, one with or the values of the calls are so different. One's a 5% coupon bond priced at a premium and callable par, and the other one's a 2% callable bond priced near par. We used OAS, option adjusted spreads, to measure their relative value. And you can see at the very bottom here that the OAS of the par bond started off a little bit higher at 16 versus the premium bond of 10. So now let's take a look at trades. So the next chart, please. Thank you. This chart shows the conventional OAS of trades from both bonds from 2016 through last year. In the case of the 5% coupon bonds, since issuance, they have remained priced well above par, and their OASs have ranged from -7 to 60 basis points. Now, take a look at the orange dots. The movements in both price and OAS for the 2% coupon bonds were far more volatile. The conventional OASs of the twos rose consistently with lower prices to as much as 150 basis points. As the premium bond did not display the same spread widening, we can infer that the widening with regard to the twos is not a credit event, but due to the rising future tax liability of the bond as its price falls. In fact, when tax costs are accounted for in the tax neutral framework, the resulting OAS is more stable and more similar in range to the 5% coupon bonds, as you can see here in this slide. So next slide, please. Thank you. So here we've added the OAS calculations using a tax neutral framework. And you can see, looking at the green diamonds, that the OAS of the 2% coupon bond now peaks at around 80 basis points, not 150 basis points, and is more similar to that of the premium coupon bonds that are to the right. So what does this suggest? First, that investors do care about taxes, which makes sense. So it's imperative to include tax costs into the price sensitivity of municipal bonds, which conventional analytics fail to do. Second, taxes can impact mark-to-market returns. Taking a step back and thinking about it, a bond with more downside than upside is likely to have a depressed expected return over both the short to intermediate term horizons, and by, in this case, I'm going to show you a pretty large margin. So let's take a look at that, and let's start by calculating a 1-year expected return for a par bond. Next chart, please. Yeah. So in this example, we're going to take a look at a 10-year bond priced at par at 2%. And I apologize, I just caught today that in this version of the deck, I have on the left the price and yield column headings mislabeled. It's just the opposite. So 2% yield, par price. Okay, now we care about looking forward as a portfolio manager. If we're worried about mark to market, we need to think about things going forward. And to calculate a 1-year expected return for this bond, we're going to, in our assumptions today, we're just going to reprice the bond off a forward curve using the AAA curve 1 year from now. And we're going to reprice it as a 9-year bond. Now, on the forward curve, the 10-year yield rises 30 basis points. And this bond rolls down the curve, becomes a 9-year bond, and its price actually will have only fallen by about a 1%. Its price falls to 99, as you can see in the middle of this page on the right. When you combine the price decline with the coupon income and a small amount of reinvestment of that coupon, and the annual mark-to-market return is 1.17%, certainly lower than the coupon. This is the mark-to-market return that an institutional portfolio manager has to worry about and will be reporting. Now, at the same time, none of us on this screen believe that our point forecasts are particularly accurate. So we're not exactly sure what yields are going to do. So we're going to create a range of possible returns. And we're going to use, in this case, a 30% volatility assumption. And we're going to assert that yields are log normally distributed. And we're going to come up with a range of return and their probabilities. Now, with that, I'm going to just draw your attention to the tails. In this environment, you know, a positive return, when you buy a 2% bond, there's a chance, small, but there's a chance you're going to get a 7.5% return over the next 12 months. At the same time, take a look at the bottom, or it's actually the top of the chart, but at the other tail, there's a chance you could also get a return of minus 18.7%. Now, focus that asymmetry really is going to hammer the expected return of a par bond, because the way I'm going to calculate the expected return now is I'm going to take the probability weighted average of these returns. And when I do that, suddenly now that negative convexity, that big downside of these bonds compared to a much more limited upside really limits the expected return on a par bond, and it comes out to only 0.14%. Okay, so that's a pretty low number. Let's compare that to premium and discount munis. And next slide, please. Now here, what I'm showing you is the returns from a par bond in the red, and let's focus on that first, at different implied volatilities. These are doing the expected returns. And the 0.14% for the par bond that I was just going through is in the red bar in the center of the chart using the 30% volatility. Now, focusing on the red bars, if expected volatility is lower, the expected return of the par bond is higher. This is because if you dampen how much yields can move, you also dampen that downside. And so then suddenly that's not part of, or the likelihood is much lower that you're going to have much of a tax hit to the par bond, and its relative or expected return rises, okay? But the opposite's true if volatility is expected to be much higher. So a par bond's expected value is inversely correlated with the expected market volatility. So now let's focus, turn our attention to the expected returns of the premium and discount bonds. And as you can see, the premium bonds really, by comparison, shine. Not in absolute terms, the returns are close to 1%, but compared to par and discount bonds, they do pretty well. And this is because the prices of the premium bonds are well above par in all scenarios. So tax liabilities don't play a role in their expected returns, really. In the case of the discount bond, it does better than the par bond. And in part, that's because the tax liabilities are more constant part of the valuation. So it's more symmetrical. The reason the discount bonds underperform the premium bonds, however, is because on average here, because we use the forward curve, we're expecting rates to rise. And the discount bonds have a longer duration than the premium bond. Actually, 14.9 years for is the tax neutral duration for the discount bond, while it's 8.3 for the premium bond. So next slide, please. So what have we shown? First, municipal investors focus on after-tax returns. Second, tax costs make par and discount munis more sensitive to interest rate changes than conventional analytics suggest. We've also shown that institutional investors' strong preference for premium bonds makes sense, as they don't want to incur the mark-to-market performance or hit of to their portfolios that a par bond might incur. So they basically just try to avoid that tax cliff and move more towards premium bonds. And we've also shown that the relative value of par bonds is really is correlated or inversely correlated with the expected level of interest rate volatility. So that's what I've covered. I want to give a couple takeaways as well to leave you with. And if we could move the next one. The first idea is that, look, in institutional, this is to issuers. Institutional investors have a preference for premium coupon bonds. So to attract institutional demand, issue the premiums, and I think what you'll see is that you lower financing costs. Now, the second part to that is something that Andy's been starting to work on a lot recently, and we can go into this in the Q&A more, but consider issuing these premium bonds with higher call prices. And right now, the standard is to have a par call in 10 years, but consider having not like 102, 105, but more like 140 or 150. This really has two benefits. The first is that it'll ensure that when you call the bond, interest rates will have actually dropped. And second, because the bond is more likely to be outstanding for longer, and it'll effectively have a longer duration, investors are going to be willing to pay more for it. And in fact, you could receive another 20 points when you sell the bonds in price. So that's a good thing from your perspective. You can raise more money. For academics, I think the point here is just know the impact of taxes. Don't just look at yields and prices. Understand also that tax effects are impacting both of them, as well as call options. We saw a little bit of that in the presentation earlier, but call options, the vast majority of municipal bonds are callable too. So just make sure you're keeping track of that. Investors, I think for most cases, institutional investors are avoiding par bonds, but we've also set up a framework here that if you know your preferences, you can also begin to play around and ask yourself, is the yield for a par bond high enough versus the premium bond that I should be interested? But let's just start with the idea of don't buy that par bond unless you're offered a lot more in yield. With that, I'm going to hand it over to Steve. And thank you all for putting up with me and my technical shortcomings.
Thanks, Guy.
No problem at all. No problem at all. Technical challenges are something I'm sure we've all experienced. Steve Winterstein, welcome. Look forward to your discussion comments.
Thanks. Good to see you, Justin. And I called Guy earlier this morning, and I said to him, we've known each other for 30 years, and I asked him, I said, have we ever been on a panel together before? And we both agreed that when the other one was speaking, we were in the audience being the primary heckler. So this is the first time that but actually I get to heckle you now, Guy. Look, everyone I think is familiar with Andy Calatay's work. He just published Interest Rate Risk Management of Municipal Bonds. Guy actually contributed to that text, and I had a small part in reading it and giving some observations. But Andy's work is widely published in academic journals, in research and so forth. I think we have a real advantage in having these two fellows combine this effort, because Guy, I've had a front row seat to his entire career, and I can tell you that we have a boots on the ground money manager, and this is not a solution in search of a problem. This is actually things that, and I had a very similar role to Guy's. We wrestle with these issues every day, premiums, coupons, tax treatments, but all in the context of liquidity, and how we're going to deal with taxes relative to the liquidity of the bond when we need to sell it, and so on and so forth. So I asked myself one question. I asked myself, why is this paper important? And that's really what I'm here to talk about, is why, not to recount the great highlights of the paper. We've had the advantage of discussing these things for quite some time together throughout our careers, but why is it important? And the first reason that I come up with, I didn't have to work very hard at thinking of 3 good reasons why this paper is important. Number one, remember that 40% of the entire municipal market is held by individual investors, right? 40% of the market is held by individual investors, and those individual investors either lack the knowledge base or the interest to understand the complications of evaluating optionality as it relates to taxes. And so it's very important in the sense that we would look at individual investors, and they would say things like, and I think, Guy, you would agree with this, they would say, I don't want to buy a bond at par. So you can buy $100,000 par at a price of 105, and the refrain was always this: if I hold it to maturity, I lose my $5,000 in principal. And so individual investors have a strong preference for exactly the kind of securities that Andy and Guy have studied here: par bonds or discount bonds, not taking into account tax considerations. So from that perspective, I think it's extremely important for advisors, at least advisors, if not the individual investors, to understand the importance of this paper. But I'd be doing the institutional market an injustice if I didn't mention also that the institutional investor understands some of the very basic mechanics of this. As an institutional investor, a fund manager understands the market discount cutoff price, the de minimis rule, and that the price will fade eventually as it gets to that point. The problem is there has never been this kind of rigor put around it. And so what do? They know that these discount bonds can have a problem with liquidity for all the reasons that Guy and Andy point out in their paper, because of the acceleration to the downside in price right around that market discount price, because of the negative convexity there, and because of the duration extension. And so there are a multiplicity of issues that an individual or an institutional investor has to wrestle with. But so what do? They largely avoid the problem. They ignore it and avoid it. And so they simply buy the premium coupon bonds, which leads me to my second point. Institutional investors buy premium bonds because we understand that there are tax implications for discount bonds, but the issuer doesn't understand that their audience is bifurcated. Now, we looked at that LAUSD bond where we had a 2% coupon at par, a 5-handle coupon at a premium. Issuers will issue those two kinds of bonds in order to appeal to those two different audiences without really understanding who they're selling it to, and understanding the whys and wherefores and the mechanics of the underlying securities. Some do, most don't. I think that's very important. And finally, and I mentioned this in passing, the third point is that Guy and Andy do something that is new to this kind of work, and it's a fresh look at things. People have done papers, excuse me, on the price performance of bonds are in and around the market discount cutoff price. No one, to my knowledge, has applied an option adjusted framework to it. That discipline is absolutely necessary. If you're not applying an option adjusted framework to this analysis, then you're falling short of the mark. And I think that's extremely important for what they do. Remember that every bond, practically every issue comes in a no call 10 structure in the marketplace. And once that new issue seasons, we start to see optionality rife in the market, practically everything. And we've seen call options actually shorten up after the elimination of the advanced refunding. So that's extremely important, the option adjusted analysis. Finally, I want to two takeaways, areas that they could explore, I think, take this a little bit further. I look at, and I had this discussion with Andy and Guy, and I think, it's an interesting discussion. I look at a tax payment on a market discount bond as a negative interest payment. It's a negative cash flow at the end of the period, right? At the end of the holding period, and sometimes it might be to maturity. If I look at that as a negative interest payment, a tax payment is a negative interest payment on that security, but I don't know what that interest rate will be. In other words, I don't know what that payment will be because I don't know what the prevailing tax rate will be 10, 15, 30 years from now. When I got into the business back in 1984, I think the maximum marginal income tax rate was 70%. Today, it's in and around 40%. So why not treat that tax payment in the same kind of discipline that we would treat an option, and do and understand the volatility of interest rates relative to this problem? It's been studied before, but I don't think in the context of an option adjusted analysis looking at the future path of tax rates, and I think that will matter. And one final thing, Justin, and I'll wrap up. We noted in the paper that once a bond goes deeply into discount, away from the de minimis, farther into a discount, it passes that market discount cutoff price and then heads deeper into a discount, convexity actually turns positive. And it not only turns positive, it becomes very positive because, and I'm going to infer that it's because now taxes are fully absorbed into the price of the bond, and now it can be convex. Because there's no more downside to it than it is already experienced. Perhaps in a higher interest rate environment where prices seem to have more symmetry in the market, now everything is at a premium, or most of the market is at a premium. As interest rates move up and maybe there's more symmetry in prices, I think Andy and Guy would do well to start to investigate and put a little more rigor around the causality of that convexity. And again, I made that inference, but there's no rigor around that. But I think that would be a very interesting thing to look at. And with that, I'll conclude my remarks. Good job, Guy. Good job, Andy. And I enjoy working with you guys and looking at these kind of issues.
Thank you, Steve, very much. Appreciate all of your thoughts on that. We have maybe a minute or two before we go to break. So I want to invite Guy and or Andy to respond to anything Steve said, if they would like.
I don't know if Andy's on, but that idea of uncertainty around taxes is one you could put a distribution around the taxes. I think that I think at the moment, what most people do is just figure the current tax rates. I want to be paid at least that, and maybe even a little more if I think rates are going to be higher. Or tax rates are going to be higher. But you could certainly make that more rigorous and put a range around, do a range around tax rates and probability weight it.
Makes good sense. Okay, well, with that, thank you, Guy, for the presentation. Thanks, Steve, for all of your thoughts.
Thanks for having us.
You bet, you bet. So we're right at a break now. Let's reconvene at 12:55 Eastern with our next pair of papers. Thanks, everyone. We'll see you then.
All right, thank you.
Okay, well, welcome back, everyone. Thanks for coming. Hope you had a nice brief break there. We'll get right back to our proceedings here with the next pair of papers. Again, consistent with the first couple of papers this morning, our next couple of papers are also from the standpoint of the issuer, and we'll bring a kind of a different perspective to these next couple sets of questions. And in particular, we're dealing with questions of the way that the underwriting process works, the way that pricing works through the underwriting process. And so with that, we'll jump right into our next paper from Steve Liu and Jay Wong. It's titled Pay Now, Play Later, Political Contributions and Underwriting Relationships in the Muni Market. Steve, welcome. Look forward to hearing what you have to say.
Thank you, Justin. Can you hear me fine?
Sure can, thanks.
Thanks. I want to first thank Brookings Institute for inviting us. It is a great honor to present our work for both academic colleagues and market practitioners. Today, I'm presenting a joint project with Professor Jay Wong from University of Oregon as a paper about political contributions and underwriting market share in the Muni market. Regarding the research question, there are three aspects I would like to briefly discuss at the front. And the first one is we're basing everything on this regulation called Rule G37. It was a rule approved by the SEC in 1994. Starting from the second quarter of that year, brokers and dealers are required to disclose all the donation information through the form G37, and that is also where we collect our donation data. And so since the rule came out and it is designed to curb the pay-to-play practice in the industry, and we just find it pretty interesting, we want to take a look at this rule, and we're more interested in during this post G37 period, how different companies react differently to this regulation, and how different contribution strategies have been developed after the Rule G37, and how they have different impact on their market, especially the negotiated market deals. And at last, we also take a look at the determinants of different strategy, contribution strategies, and we want to see what determine a different choice in terms of deciding what strategy will be a proper way to establish political connections. Why is this a good setting for us to look at this question? So, on one hand, it's interesting that we know official issuers are running campaigns in the public office, and they're trying to secure the election by collecting fundings. And so, on the other hand, underwriters obviously want to, obtain government contract. In this context, we were talking about a negotiated market deals from local government. So there are two layers of relationship. One is the political relationship. The other one is the business relationship. So we just want to see how these two interact with each other in this specific setting. And I think I don't need to address how important the Muni market is to the economy. And next, let's just take a quick review for this Rule G37. As I mentioned, in April 1994, and this rule was implemented, and the goal for this Rule G37 is to better regulate and the market political activities, and somehow to prevent the pay-to-play practice, to make the market more transparent and improve the the industry equality. So there are two parts of this rule I want to point out. One is the disclosure requirement. So as I said, dealers and brokers will start reporting all the details to the board. And also there's a business prohibition term in this regulation, which is, I will show you this form. So two parts of this form. On the top part, we have this contributions made to issuer officials with names, office, amount of money. And this bottom part is this one is called payment made to political parties of states or political subdivisions. And this one, we don't have any specific names or office or campaign information. And that is called, we define this type of donation party donation, and this one is a candidate donation. And there's also something more interesting regarding this rule. The second part, as I said, is a prohibition rule about this political donation for campaign candidate. And the specific rule states that whenever you made a donation to a specific campaign candidate, you are subject to the 2-year business ban during the following 2 years. In other words, you can't do business with them, especially the candidate officials who may have influence over the lead underwriter selection process. So there are exceptions. These are more interesting, okay? So as I said, the party donations are not subject to any restrictions. You can donate to parties, you can continue doing business with the local government. And there's one exception that is making this very interesting, that is called the de minimis limit of $250. There are 2 conditions. If you meet these 2 conditions, you're immune from the 2-year business prohibition term. And the first one is if the donor is an eligible voter for the campaign candidate. And also the total amount of donation is not exceeding $250. It's not a big amount. It is pretty strict, right? So, and that is how we think it's necessary to classify, different types of donations in our work. So obviously we have this large donation defined as donation exceeding the minimum limit of $250 to a campaign candidate. Right here, we call this large donations in our work. And also we have the bottom one is called party donations. As we saw, it's the bottom part of that, and they're not going to specify who is going to receive the fund and how they're going to spend the fund, right? Who are they going to support? So the board believes this is kind of a not directly effective relationship later on. And there are all other small amount of donations made to campaign candidate. And there are 2 other types that we define right here. Let me show you the second sample very quickly, and then we go back. We'll come back to this page. This is the first one, and now we see the amount of donations right here. It shows 1,200 and 5,000 right here, and made towards the state treasurer and the governor candidate. And this one is to the Republican Party of Illinois. And this is the second one. If you can't see this very clearly, I just want to explain this for you. I circled 6 $250 donation by the registered representative. They're exactly $250, and they're all made to the state treasurer candidate. And if you look closer at this form, this is from the single quarter by the single firm, right? There are also repeated pattern for $250 donations made to the lieutenant governor and the state attorney general. And that just made us think maybe it's necessary to single out some of the smaller amount of donations. So we classify that type as multiple small donations made to the same candidate. And it made us think it's possible that just at the same time, multiple employees just want to support one candidate. It is also possible this is the way to circumvent, the 2-year business prohibition term. So that is why we want to just take a further look at this type of donations. We call this small donations, and all the other single small amount of donations are classified as small donations right here. So overall, we have large, small, and party donations. So we're going to look at how this different type of donation strategies will play different roles in the underwriting market relationship. And how do we fit into the literature? This is the first paper using this term political contribution strategy a lot in the script. So there's 3 different streams of hypotheses I want to point out very quickly. The first one is investment-based hypothesis. The argument is companies and those sales representatives are making donations and they're looking for payback. In this context, they're looking for a government contract, right? The Muni contract. And the second one is consumption-based hypothesis. The argument is it doesn't have to have any intention. You know, political relationship and business relationship can be two separate sets of relationship, and they just want to, you know, donate to someone they like, and that's it. And the third one that we think is also quite relevant to our work is called long-term relationship hypothesis. Snyder 1992 argued that sometimes donors may not look for immediate payback. So sometimes you just want to establish a relationship and also maintain a long-term relationship with the local officials. It is also possible. Next, we're going to show how we test these different strategies under the framework differently and how we observe some different outcome. The first set of finding that I'm going to show, because the time limit, I'm going to show you more. I'm going to focus more on the qualitative part of the finding instead of showing you table after tables. So the first set of finding right here is we find both small and large contributions are associated with higher negotiated market share in the following years, but they're having a different impact. And this is how they're different. First of all, 1 standard deviation increase in multi-small donations are associated with 2.34 increase in negotiated market share in the next year. Large donations, they also have a similar impact on their following year's market share, but now there's 2-year delay. So that is the difference. We attribute this pattern to the business prohibition term of Rule G37. And to double check the baseline finding, we find it's necessary to confirm it is the political influence that is playing the role in the market relationship instead of other observed factors. So we use 2 subsamples, one with donations to elected candidate, and the other one is donations with unelected candidate. And we're just looking at the different outcome with different type of candidate with different type of donations. So the first subsample shows strong impact on the market share, and also the coefficient are showing a large magnitude. However, the other subsample with losing candidate don't have any strong impact on the following year's market share. So this has made us believe it is more likely the political influence that is playing an important role at driving our baseline result instead of some non-political factors causing this relationship. And we also did similar tests on the small and party donations, but we couldn't find anything significant on those donating underwriters' future underwriting market shares. And this is our figure 1 in a paper. It basically summarized how different strategies play out during the pre-donation period and during the after donation period. I want to point out one thing is right here, you look at party donation, multi-small donation, a small donation, and large donation. During the pre-donation period, and this one is on the top, meaning they're relatively speaking doing quite well in the local market. But 5%, 6% is not very dominant, but still relatively better than the other type of target states. For large donations, on the other hand, they are targeting a stage they're not doing so well, okay? And they're just barely having some market share in those states. And after the donation, year 1, year 2, there's no impact, and 3 and 4, we start seeing some impact. For multi-small donations, we see the impact is kind of earlier than this one, and also the increase is more strong compared with other donations during the post-donation period. And the second main part of our finding is we just take a look at how different strategies are determined. So we find, except for large donations, all those within the pair of the state and the underwriter, all those donations are pretty persistent over time. And large donations and multi-small donations appear to be substituted to each other, meaning they're not being used at the same time. We think it's because of the 2-year business prohibition rule for the large donations. And also we find national underwriters are more likely to choose large donations in states with high growth rate in negotiated deals. And we find regional underwriters will prefer multi-small donations to mainly focus on their regional markets. And also underwriters who like to make party donation would like to target at states where they already have a good business relations. And that is the second part of our main finding. And overall, I think I'm running out of time to go over this. It's pretty standard for the data source, except for the Form G37. We use all those donation information from the Msrb's website. And besides the election result, and we also use the competitive market share as our dependent variable to run a placebo test, but we don't find any significant result out of the placebo test. Meaning it's unlikely that is some competitive advantage of those donating underwriters that, having the market share change during the post-donation period is more likely the political factor that is playing a role. So overall, we think it is interesting to find that this political connections still play an important role in the market, even after the Rule G37, and different strategies have been developed. And underwriters try to advance their underwriting relationship with the local issuer officials. And that is all I got for this paper. Thanks for your attention and time.
Thank you very much, Steve. Much appreciated. And thanks again for staying right on time. Appreciate that. Our discussant for this paper is Larry Fowler from the University of Tennessee. Larry, welcome, and look forward to hearing what you have to say.
Thanks, Justin. I appreciate that. All right. Justin, is that you can hear me and everything's viewable? Looks good?
Yep, you're good to go.
Great. Thank you so much. So I appreciate it. Let me echo thank you for inviting me to discuss this paper. I appreciate the opportunity. So let's get into it, I guess. And so let me just summarize. Steve did a great job. And so just want to make it just kind of in one slide, just what's going on in the paper so that kind of an idea. So the authors examine if the political contributions made by muni bond underwriters in these negotiated bids leads to future underwriting business. And the sample is from 1999 to 2013. And they conclude that multiple small donations and large donations lead to an increase in future business. The caveat here is the large donations, because of Rule G37 with the 2-year gap, they see this not happening right away, but it happens after that 2-year gap is up. And so most of this evidence is attributed to winning candidates in elections. And then further, Steve mentioned this toward the end of his presentation, that regional underwriters choose to donate through multiple small donations, and national underwriters make large donations in high growth states, right? And it's probably not surprising that underwriters contribute in areas where they have a strong presence. So let me get into what I liked about the paper. And so I always like to kind of say what I liked. I think that's important. So I think it's an interesting topic. I've done some research on it in the past. I think the authors do a great job in looking at the topic. They try to tackle, they address causality, right? This is a big issue in empirical work. And so, and I think the questions and answers are important to investors, the market, municipalities, and so on. So I think that's really bodes well for the paper, and having those 4 things is great. So let me get into some thoughts, questions I have, and I don't know that I have answers. There are more questions and things that Steve and Jay Wong could look at, hopefully, and see what's going on. So basically, I think these 3 are related, and I think, as I mentioned, it's important and relevant. But what additional benefit do we gain here, in the sense of, okay, so they gain market share. Does this actually have an impact on the municipality? So do investors pay for this? What's happening, say, to the price of the bonds? Do we see this actually because of this is the valuation or the price of these bonds being impacted. And so maybe this is some type of efficient arrangement. I'm not sure that I would argue that, but is there some expertise gained? And so are some deals more complicated than others? And so bringing in certain types of underwriters may be more beneficial. And I think just a little more on the contribution of the paper. I think it's there. I think some of this just needs to be teased out. So the results on the large donations, I know inherently there are some issues with long-term studies, and so are there issues here? Are there some other things that can be controlled for or maybe looked at differently? There's a lot going on right over those 2 years. Maybe pin down the channel a little bit more in the sense of, the economic magnitudes are huge in terms of, what goes on and in terms of the market share that they gain and so on. But the dollar contributions seem a little bit low than given what the increase is. The discussion on political ideologies mentioned in the paper. Can they explore that a bit more? Is this why we see these results? I kind of like that avenue. Maybe also discussing the sample a bit more. How many instances do underwriters contribute to different candidates? I think it was discussed that it doesn't happen often, but do they stick with the same party? Are they hedging their bets? And who has authority over these deals? So can they decide which deals are negotiated or not? Meaning, the municipalities. Does this vary based on contributions? Why exclude underwriters that never contribute? I was trying to think it through, and I really couldn't decide one way or the other. And this is in footnote 19. Just a little more, and then I've got one more slide to wrap up, but maybe how the election outcome analysis handles endogeneity concerns. I was trying to connect the dots, and again, maybe I was missing something. It wasn't quite clear to me. Do the underwriters gain even more market share after their candidates are elected? So in other words, do they gain when they're not, but then even more? So also some of the observations throughout the paper, either what's lost, example in the multinomial, sometimes the authors mention about some obs are lost. It would be interesting to just kind of maybe detail a little bit. I know the authors say they're not quite sure why these negative coefficients exist in table. I forgot to put the table there. I think it's table 4, maybe, specification 3 there. A couple more. Figure 1, and Steve put that up, shows a huge jump in market share for underwriters. Is this concentrated only on a few? I know there were 2 of the contributions, they dropped a little bit after a year or 2, but is this only a small handful that really gain, or is this kind of consistent across all the underwriters? Something I didn't quite understand in table 2, panel A, all the donation compared to the rest of the donation, I would have thought that would have added up, but again, maybe I missed something. I got 595 versus 701. And then this is related to 15, why the differences in the sample size. Sometimes it appears like maybe we're comparing different samples. And so it would have been nice to see where, say in table 4, those almost 6,000 observations, where do they come from? And I didn't see that mentioned. So finally, again, just some minor quibbles, and just to be thorough, the placebo test isn't necessarily handle causality. I mean, it's close. I mean, it just really highlights that things wouldn't change for the treated firms without the treatment. Maybe it's semantics, but just kind of keep that in mind. And I know that the authors need two years post to look at that because of the rule. But why stop in 2013? Could they go a couple more years? Again, these are somewhat petty. How many observations are lost in footnote 23? And so maybe I've focused on the sample too much, but and then lastly, just a few minor typos, but otherwise, just table 6 was a bit confusing, I should say, to me. And so maybe they could look at some other things. This kind of ties back to my earlier point about the election, whether they're an incumbent or not, or maybe they can, Stephen J. Wong can look at that a little bit different or slice that up a little bit different to maybe get at that a little bit perhaps better. But thanks so much. I enjoyed the paper and thank you again.
Thank you, Larry. Appreciate a really thorough review of that paper. Before we get to questions from the audience, maybe give the authors a chance to respond to anything that Larry said in his discussant remarks, anything that struck you just as you were listening that you might want to respond to first and foremost.
Sure. Thanks, Larry, for the thorough review on the paper, and also thanks for pointing out those important, part of the paper, and especially thanks for pointing out the weakness of the paper and also how we can additionally bring to the contribution for the work. First, I want to, I think the cost of the bond and how the welfare impact is very important. I strongly agree with you on that. We're currently working on that. So far, we don't have we don't find anything significant yet in terms of the cost of capital and underwriting fees. But we're going to see, because that will require us to break down to the ECU level. And so far we just aggregate everything up on a state year level. So that will require a little bit of work and time to sort out. And hedging, I think, yes, a lot of times those donors are pretty consistent and they're donating to the same party over years. But we do observe some hedging donation strategies over time. So overall, we just find if a connection is established with the right party in office, I think that is a political connection. So that is how we define such connections. But I think it's interesting to look at that as well. We'll think about that. And also the authority and what specific office, that is a quite challenging question, because we really don't know where to find connections between, say, what kind of issuers is under control of the governor's office or treasurer's office, what type of issuers are not influenced by those offices. So we'll keep thinking about that, because it is important to establish a more clear link between the two parties. And why do we exclude the never donating underwriters? We just think, fundamentally they're quite different from the treatment group of the donating underwriters, just in terms of market share, in terms of market condition and competitiveness, they're not quite comparable to them. But adding them won't change our result. And in table 2, I think Larry pointed out one part about the donations, because there are overlaps. So if you see 595, including some overlap, but overlap is not quite often. And so if you add up separate strategies, they will probably go over 700. But taking out an overlap, just counting the donation year state, that is the total number of donation that we use in a sample. Overall, we really appreciate the comments and all those advice. We'll continue working on this project. And yeah, thanks for the advice. Thank you.
You're welcome.
Terrific. Jay, anything to add there?
Sure. Larry, thanks again for all the wonderful comments. Clearly, the paper is still in a sort of a preliminary stage. This is only our second draft. So we'll definitely try our best to incorporate your comments and make it more polished. Just one quick comment about the donation amount. I agree with you. The dollar amount seems to be small compared to the economic magnitude in terms of the market share they gain afterwards. Our interpretation is I actually look at quite a few papers in the political contribution literature. It seems many papers suffer from the same issue. The dollar amount donation seems to be small relative to the economic impact documented from this post-donation impact. My sort of the take on this is this political donation is only one part of activities these people do to connect with politicians. There may be other behind the scenes that we do not, as economists, we do not observe. Okay? But as long as the dollar donation amount is kind of positively correlated with those unobserved connection activities, then I think we can still push through our same interpretations. This is only sort of the best explanation I can give it to you, but I agree the dollar amount is kind of small relative to the economic benefit we document here. Yeah. Thank you.
Very good. We do have a question from the audience, actually from Mark Jaffe, who presented yesterday. And I think you speak to this a little bit in the paper, but just for the benefit of the audience, the question is, did you download the political contribution disclosure forms from Emma? And could you speak a little bit to how you went about parsing those data and built the data set that you use in the paper?
Oh, we're doing the old-fashioned way. We just collect them manually and we just sort them out and transform them into spreadsheet tables, and that's how we do it. We didn't really rely on any programming language to manage the text because a lot of old files from the 90s, late 90s, they're scanned PDF, so it's kind of hard to, visually recognize that by program. So yeah, we just want to ensure the quality of the numbers and information that we collect from the website. We just manually enter those numbers.
Well, my apologies to your research assistant or you or whomever was in charge of doing that, because that sounds like quite an undertaking. Jay, any response to that?
No, yeah, that's exactly what it did. Steve did most of the work there. So
terrific. Okay, well, any other? I want to give our panelists or I should say our authors and Larry a chance. Anything else that anyone would like to comment on here that's come up in the course of the discussion before we wrap up and move on to our next paper here? Any other anything else for the audience to take away from the discussion today?
Justin, let me, I would like to just, I think Jay, you raised a good point about the unobservables, right? That inherently in all these papers, that's what's missing, right? Is why such a apparently small, donation or political contribution leads to such a huge economic magnitude. And when you mentioned that, I just thought maybe, and I don't know how difficult this is because I would assume it would have been done, but maybe there's some other intangibles that can be picked up or that you can kind of examine since you've downloaded this by hand, or you kind of involved, when you're really involved with the data, maybe there's something there that can pick that up, like the complexity of the deals or whatever it may be to proxy for something else. But I agree with you with your comments, but it would be nice if you really had a nicer, not nicer, but a channel or some other intangibles to correspond with it. But overall, it's not an easy proposition. So that's all I wanted to add. So.
Terrific. Well, thank you all for a great paper, great discussion, and lots of great conversation. It's definitely a salient topic and touches on a lot of things that we've talked about throughout the course of the conference and will continue to talk about throughout the course of the conference. So with that, we're running a minute ahead, but that's all right, because that just means we'll have a little bit more time then for our next paper, which will be presented by Peter Orr. And this paper deals with, again, a topic that's come up a couple different times already, but that's the role of the federal subsidy in the muni market. And along with Rich Reifel and Marty Luby, Peter's come up with a paper titled Direct versus Indirect Federal Bond Subsidies, New Evidence on the Cost of Capital. So keeping with our theme of the issuer's perspective in the market. And then this paper will be discussed by Sarah Snyder from Ramirez. Welcome to both of you. Peter, 15 minutes. Look forward to hearing what you have to say.
Great, thank you. Can you guys hear me all right?
Sure can.
Okay, excellent. And you can see the screen? Not yet. Hit share on that. All right, how about now?
Looks great.
Excellent, great. Well, thanks for the opportunity. Happy to be here. As Justin said, we're looking at the direct and indirect federal bond subsidies, and in particular, a comparison of cost of capital of the two. ultimately getting to the question of what is the right subsidy if there is going to be a direct version of support for public purpose projects. What is the neutral subsidy rate for a direct subsidy program the federal government should employ to achieve some level of neutrality between tax exempt and taxable programs? I'll let you read about our backgrounds online. We had that introduction already. But from a research perspective, there has been historically both indirect and direct subsidies of, again, projects deemed to serve a public purpose. The direct subsidy program was embodied in the Build America bond program, which came into being after the financial crisis. What has been much more common historically is a indirect federal support, and that is via the exemption of federal income taxes on municipal bond interest. So that has provided a lower cost of capital, all else equal, to municipalities for many decades now. And when we look at the criticism that's been in play for quite some time, when you're evaluating as an investor, and this has been discussed in prior panels as well, when you're evaluating as an investor what sort of yield to accept on a municipal bond, there's uncertainty there in not knowing what the benefit of that tax exemption will mean, because we don't know what income tax rates are in the future. There have been changes to the tax code. There will be continue to be expected changes in the tax code, but there's uncertainty there, and that uncertainty has led to a criticism that the indirect approach is inefficient in terms of the U.S. taxpayer getting a certain bang for the buck. The BAB program was designed to correct those deficiencies because it's a direct payment, one that ultimately the investor doesn't really have to worry about because they're getting their taxable payment regardless, and they have to deal with their own tax consequences of taxable income. The original BABS program offered a 35% subsidy. It was in place from early 2009 to the end of 2010. There were a little less than 200 billion in BABS issued, and the thing that occurred subsequent to those issuances was, due to the federal budget sequester, there has been a reduction in the amount of BABS subsidy paid to issuers. And one way, I think issuers need to think about this is that the municipal bond program gives them a nominal guaranteed payment stream when they issue municipal bonds. They have shifted that risk that I mentioned earlier of the change in tax rates. That's really borne by the investor, because again, the investor doesn't really know the benefit of that tax exempt income in the future due to the uncertainty of marginal income tax rates going forward. However, BABS have essentially and effectively given that risk to issuers in a certain sense, in that, and this actually happened. I wrote an article about this as soon as the BAB program was introduced back in the late 2000s. But it is a direct payment, which, as a flying duck overhead, is a real target for cutbacks when the federal government can't get things going in a balanced sort of way. So there's been a haircut due to federal budget sequester, which has actually resulted in effectively an increase in net payments by issuers due to that haircut that's occurred to the sequester. There have been a number of proposals related to extending the direct subsidy bond program, the America Fast Forward bonds. There was some discussion under the last administration about also having another direct subsidy program, but it was ultimately not included in the 2018 discussions of the tax program then. There is something floating around now, or last year rather anyway, and this was even a bit more complicated. They were talking about a direct subsidy rate that was high, over 40%, and then would ramp down over time. And so again, question being, what is the direct subsidy rate that will induce issuers and investors to use the program relative to the traditional and more common municipal bond program that's out there? So in prior research, one of the things that was missing was an acknowledgement and an analysis of the fact that when the taxable BAB programs were issued, they tended to include a make-whole call, which at the end of the day created a calculation that to the issuer meant that even though they could refinance the bonds, the make-whole component of that effectively left them with an uneconomic call. It wasn't like a traditional call where you're taking the bonds out at par or some modest premium. You were effectively making a payment to the investor that made them whole, hence make-whole call. Whereas traditional long-term tax-exempt bonds would usually carry a 10-year par call, so that all the bonds after 10 years in maturity in a given series of bonds would provide for an economic refinancing of those tax-exempt bonds. And so if you're going to compare the taxable BAB program to a traditional tax-exempt bond program, you need to account for this call feature. And that's what prior research lacked, and what our research attempted to go ahead and include. So based upon some other research that I had done with Marty Luby, we used a refunding adjusted yield, which took into account the refinancing ability of those tax-exempt bonds. And based upon simulating the behavior of municipalities and how they actually make refinancing decisions and the use and monetization of those tax-exempt call features, we included a refunding adjusted yield to account for that refinancing flexibility, which tended to make the calculation of expected yield for the tax-exempt bonds more realistic once you include the monetization of that call feature. The refunding adjusted yield essentially recovers the market price of the bonds based upon the simulated debt service of the issuer, accounting for that future refinancing activity or refunding activity, as it's called in the marketplace. We used 5,000 simulations of refundings using an opportunity cost index, which is one that is used by tax-exempt borrowers in the marketplace. So how do the calculations actually work? Just going through a quick example. If we have BABs that were issued at a nominal cost of capital of 10%, if we include that 35% subsidy, that brings us down to 6.5. If you compare that to a hypothetical tax-exempt bond at 8%, that would be the true interest cost. True interest cost is a calculation that assumes debt service just goes to maturity and there is no refinancing involved. If we assume that the refunding adjusted yield brings that 8% down 50 basis points to 7.5, then we're looking at a comparison of a BAB benefit of 1.5% when looking at the BAB TIC versus tax-exempt TIC compared to a 1% benefit using the BAB TIC versus the refunding adjusted yield on a tax-exempt bond basis. This leads to a 33% overstatement of the BAB benefit relative to a more realistic refunding adjusted yield cost, which when you're comparing subsidy rates means that you've understated your neutral subsidy rate by 25%, namely a neutral subsidy TIC of 20% versus the more realistic 25% for refunding adjusted yield. So that's ultimately the risk of not including the benefit of the call feature embedded in the tax-exempt bonds when it really belongs there. Here's an example using the University of California Regents. The actual BAB all-in TIC with the subsidy was about 390. The tax-exempt all-in TIC issued at the same time was right around 470, But after reflecting in the far right bar for the refunding activity, the refunding adjusted yield, that brings us down to more like a 421. When we look at the actual benefit then calculated using TIC at 64 basis points, but using a more realistic refunding adjusted yield cost of capital for the tax exempt bond, that brings it down 19 basis points to 35. And if we bring that to its natural conclusion in terms of a neutral subsidy rate, the implied neutral subsidy rate using a traditional TIC was about 25%, and using a refunding adjusted yield, it gets us closer to 29. So you can see the error there, we would argue, in not including the refundability of the tax exempt bond. And looking at this across our analysis, the stated taxable BAB subsidy rate was 35%. The actual BAB subsidy rate was something a bit less than that based upon the sequester that actually occurred, which again meant that municipalities were losing out on a portion of that sort of promised subsidy rate, and then taking that risk on effectively, versus a neutral tax exempt subsidy rate based upon TIC, which is a little bit less than 25%. That we would argue is again an error because it doesn't include the refinanceability of the underlying tax exempt bonds. If we adjust that back to the neutral subsidy rate, it gets much closer to 30%. So that's sort of the cutting to the chase of the analysis. So we've got a couple minutes left here. So BABs did provide some interest cost benefit versus tax exempt bonds, but smaller than estimated in previous research. This benefit is even smaller when accounting for the sequester, and even smaller still when accounting for the call feature that's inherent in tax exempt longer dated bonds. Again, our conclusion is that something closer to 30% would get you to sort of a neutral subsidy rate in the direct versus indirect programs. And ultimately, this should inform any future programs that that Congress may enact. I think that's the bulk of what I wanted to address here, with a couple minutes to spare. I yield my time to Sarah.
Thank you, Peter.
Thank you.
Much appreciate that.
You bet.
So with that, as mentioned, welcome Sarah Snyder from Ramirez to offer some discussant comments. Welcome, Sarah.
Good afternoon, everybody. Thank you, Peter, for sharing your findings with all of us. I agree with the main points given throughout the report, and do my best to provide some key points on the historical aspects of the Build America Bond Program, direct subsidy program, but then also bring forward to current day, as we have seen a shift in the taxable market, as we start to discuss bringing back direct pay bonds and as part of this, bipartisan infrastructure plan. So I'm going to share some slides. Hopefully they come up. Can you guys see the slides?
Sure
Hopefully.
can. Thanks.
Okay, great. So again, thank you to everyone for being here, and kind of moving forward. I put some points on the next 2 pages, but kind of just going to talk through. So obviously, as Peter mentioned, it's important to recognize the major structural differences in both the tax exempt and taxable markets with respect to optionality. I'm not going to necessarily go through the differences between the two, as Peter did that. But make-whole calls are still the preferred structure for most taxable investors who seek to match long-term assets and liabilities, and do not, necessarily want to have bond cash flows disrupted by the having the bonds called. However, we have seen a shift in this, and I'll talk about that going forward. But one thing that we would say wasn't necessarily discussed too much in the paper was that we would say probably in 2009, when BABs were first introduced, they were predominantly issued with the make-whole call. And then as we as investors and issuers got more comfortable with the program, 10-year par calls did receive more acceptance on the deals as we moved into 2010. The numbers I'm kind of roughly coming up as we found about 35% of the larger deals in excess of 50 million had a par call. And, as I said, there was greater acceptance for that. And even more so as we move forward to today in the taxable market. One of the important points highlighted by Peter and in the paper by Marty and Rich was this life cycle of a bond and using RAY. Obviously, municipal issuers are used to selling bonds that they plan to refinance in the future. Most tax exempt are sold with a 10-year par call. And about nearly half of all issuance today, for the last 10 years has been refundings. So this is a common practice for our municipal issuers. So I agree with the point when you're comparing a make-whole or non-call bond to a tax-exempt par, you need to take into account as well that refinancing flexibility. And as we look at direct pay bonds in the future, as well as other variables, such as sequestration. One other nuance that I just going to mention here that's actually on the next page, but was that one of the challenges as well with issuing direct pay bonds was the ability to capture.
Sarah, your slides aren't advancing.
Oh, no, I'm still on this slide. Sorry.
Okay, fine. Thanks.
It's okay. I was just saying that it's on the next slide, but I'm going to talk about it here. Was that over the years, one of the challenges with direct pay bonds was the ability to capture the subsidy and the revenues pledged to the bonds. So, over the years as bankers, we've worked with issuers to incorporate this into their documents. And just something that we want to point out as it relates to direct pay bonds in the future is, the ability to have that. And as this program may come back, we obviously suggest to issuers incorporating that. So, let's kind of move forward to today and look at, obviously the paper was written more so looking back at BABs and how they were issued. And the market is obviously, significantly different than what we experienced in 2009 and 10. And as we start to discuss, the infrastructure package and this potentially coming back. So as I mentioned that, want to point out kind of the changes. And so, the question is really going to be, will municipal issuers seek to take advantage of this type of program and who will it really help? And the factors that come into play really are the relationship between tax exempt and taxable bonds today. We're in a very low interest rate environment, historically low, as many would say, and both markets are extremely healthy for municipal issuers. We've also seen a tightening of credit spreads. So I say all this to mean that the level of subsidy that Peter talked about, we also agree that something as low as 28 or even lower really probably will not work for most high-grade issuers at this point. And so, an issuer's initial question is really going to be, is it going to save me money? And, the overall direct payment bond program, while it would give governments another option to finance needed projects, as we bankers like to say, it's another tool in the toolbox. We understand that, the argued benefit is an expanded investor base and potentially lower cost of borrowing. But again, there are several considerations for our issuers and whether or not it's a viable program for them to use. So when I talk just quickly about the taxable market and how it's changed, we've actually seen a significant increase in taxable issuance, as I show here on the slide. As we saw tax exempt advance refundings go away, we saw taxable issuance in 2021 and 2020 really pick up to similar levels we saw in 2009 and 10. So you're looking at anywhere from 20 to 30% of the market now compared to the average, which is 8%. And so this increase in taxable issuance has really increased the buyer base for taxable debt as well. So to the point of, yes, a direct pay taxable program does have a stronger, not necessarily stronger, but it has a large buyer base as well. But we are also seeing a very healthy tax exempt market. The other thing I'll point out is as being a difference between 2009 and now is that we've seen an increase in acceptance for par call options. So that's where we're now going to maybe comparing a 10-year par call on a tax exempt to a 10-year par call on a taxable direct subsidy. So being able to apply that kind of RAY component to both of those, being able to refinance. But we are seeing a greater acceptance of the 10-year par call. In fact, this past week, we saw California State University issue 2 index eligible term bonds, one with May call and one with par call. And the spread between those has really compressed significantly as compared to back in 2009 and 10.
Sarah, I don't mean to interrupt, but we're still on your first slide here. Have you been advancing?
I did. It didn't go.
No.
I don't. I'm moving it on the page. I apologize. Is that on page 2?
There we go.
Now it is.
Okay. Yeah, I don't know why it wasn't moving. That's strange. So just to kind of wrap up, I think my last point really is going to be the kicker for all issuers, and the impact of sequestration on BABs. And at the end of the day, I think issuers have been, I guess, a bit burned by the program in the past. And, I know that if there are many people trying to work to avoid an impact of sequestration on a direct subsidy program going forward, but there has also been recent conversations about extending the sequester. So again, I think that's going to be one of the main drivers of whether or not issuers decide to use this type of program again. So I think that's all I have right now. So thank you.
Terrific. Thank you, Sarah. Appreciate all of that perspective from the banker's perspective. First things first, Peter, any immediate reactions to any of Sarah's comments?
Yeah, no, it's I think important to point out the market dynamics have changed quite a bit. The taxable market, as she said, has really, for municipals anyway, has grown quite a bit ever since the preclusion and prohibition of tax-exempt advance refunding, and also the greater acceptance, as she mentioned, of traditional call features, what we would call traditional in the tax-exempt market, on longer-term taxable munis. That changes the dynamic, and on a going forward basis, probably want to revisit the research looking at the market dynamics of today versus what has occurred historically. But yeah, those are good points. Thank you, Sarah.
My pleasure.
Terrific. So one question that has come in from the audience is, and you've both kind of hinted at this, but maybe just to take it to its natural end here, given the policy discussion that's happening, particularly in Congress right now, how would you both advise on the design of a new BABS program, or BABS 2.0? Spoke to the concerns about the sequester and the need to make sure that those revenues are ring-fenced somehow if possible. But generally speaking, if you're advising members of the Ways and Means Committee right now, what advice do you give about design of another version of BABS?
I would form a blue ribbon panel first to analyze the situation. No, I'm only half kidding. I mean, I think the objective of a federal program is to try and support the financing of those activities and those projects that are deemed to be in the public good, right? It's the inherent question public finance is trying to answer in some ways. And to that end, getting a handle on whether or not having a BAB-like or a direct subsidy program and an indirect subsidy program does in fact expand the investor universe for the accomplishment of that goal, right? I mean, you'd certainly think that having both taxable and tax-exempt bonds may ultimately drive down the cost of capital for the purpose of public projects across the board. But I think you'd want to look at that, and then based upon that, figure out what the best bang for the buck is for the U.S. taxpayer in terms of setting a subsidy rate at a level that ultimately sort of balances that expansion of the market against the cost of the program, both in a direct and indirect way. I mean, the difficult thing for the federal government as it relates to the indirect program, the sort of traditional municipal bond, is they don't know how much it's really costing either, because marginal tax rates are unknown to everyone, not just us outside of the Beltway. So how much that will be for a 30-year tax-exempt bond issued today in 2035 is a bit of a finger in the wind. So there's risk there to the federal government in some sense that is an unknown quantity. Another opportunity for Monte Carlo simulation, I guess. But yeah, I wish I could just say, well, they should do it this way today. But I think there is some more research that should be done before giving a clear answer on that. But it's certainly a good question. Thank you for it.
I would just also add, agreeing with your points, Peter, that, similar to the indirect program, the tax rates changes, the relationship between tax exempt and taxable changes. So obviously, as you say, avoid the sequester. We definitely don't want sequester, but maybe the rate that they benefit from has to change over time for those issuing that day. Not necessarily, if once you've issued, it stays with that subsidy, but the benefit, if you actually want your issuers to use it, may need to change over time, that percentage, to actually encourage your issuers to use the program. Because again, they're the ones who need to necessarily benefit if you're going to have this as an incentive to build infrastructure. They need to have their lowest cost of capital.
Yeah,
they're going to take on the risk.
Yeah, I wonder if the U.S. Treasury would be willing to take on sort of the delegation of that authority,
right.
Adjust the subsidy rate around as markets move. That's an interesting idea. Yeah.
Sorry, kind of a follow-up to that, and you've both spoken to this just a little bit, but given the surge in taxable issuance, certainly over the last year, 6 months, year, and there's some specific reasons, we think why that's happening. In your view, does that potentially diminish the value of these sort of direct subsidy bonds, or does it maybe increase the investor base? Is there an opportunity here for some of the trend we've seen over the last couple months to kind of stick and have some policy implications going forward?
I do think that it obviously helps further the argument that there is a strong base for taxable municipal bonds, but when at the end of the day, when you have two options, whether it be a tax exempt new money or a taxable direct subsidy, you're going to pick the ones that cost you the least amount. Similar to when that program was issued, most issuers only sold them on the part of the curve that benefited them. So I do think that it furthers the argument that there is a healthy market on both sides. But if we want to encourage infrastructure at the lowest cost, we need to make sure that those who are actually borrowing achieve the lowest cost.
Yeah, I don't think I have much to add. That's totally agree.
That makes good sense. Anything else either of you want to add to the conversation here before we take a break and get ready for our next panel?
I don't think so. Thanks for the opportunity. Happy to be here. Great program.
Thank you for the opportunity. I truly enjoy being part of this every year, so thank you.
Wonderful. And thank both of you. So with that, we'll break 5 minutes early, so have a 15-minute break rather than a 10-minute break. So we'll reconvene at 2:15 p.m. Eastern with our panel of issuers. We provide some market perspective on a lot of the themes that we've talked about here today. So we'll see you back at 2:15 Eastern. Thank you. Okay, welcome everyone. We're back for our final panel of the day, which will be a lively conversation with a group of muni bond issuers who have been dealing with many of the very issues that we've talked about throughout the course of the conference so far. Really excited about this panel. It's an opportunity to bring together people not just with boots on the ground experience in the areas that we've been talking about, but also to bring together a really nice mix of folks from different segments of the issuer market. I won't go into a lot of detail.
Can you make it big?
Won't go into a lot of detail about their backgrounds just because we have information in the program, but just to very quickly tell you about who they are, going in alphabetical order. We have Dwight Burns, who's coming to us from the Dallas area rapid transit. So he's giving the sort of transit perspective. We have Manju Ganarwala from the Commonwealth of Virginia. Welcome. We also have Lakshmi Komi coming from the city of San Diego to provide the kind of big city perspective here. And Uri Monson, who is with the School District of Philadelphia to provide the school district perspective. So welcome to all of you. Thank you for being here and thank you for all the great work that you do. That work often goes unappreciated, but certainly not by this audience. So we're thrilled to have the opportunity to talk to you here today. Our basic umbrella heading for the panel is to talk about what issuers are doing to navigate the what we'll call the post-COVID muni bond environment. And what we mean by post-COVID is really two things. There's certainly one, the direct impacts of COVID, the pandemic itself, the changes that that's forced in what we're financing and how we're financing it. And then the second piece, in some ways potentially more important, is how the response to the pandemic is changing what we finance and how we finance it. And in particular, the huge inflow of federal money that has already happened and is likely to happen in the event of an infrastructure spending package or some other ongoing federal support. So when we say post-COVID, we're talking about both the pandemic and the response to the pandemic. We wanted to touch on three main themes, and each of our panelists is going to speak to their individual experience, their jurisdiction's individual experience with each of these three themes for just a little bit, and then we'll have plenty of time at the end for conversation with the audience. Those three themes are number one, priorities. So how has the post-COVID environment shaped and reshaped what you're spending money on? What has happened in your capital budget? Are projects moving faster through the capital budget? Are certain kinds of projects moving less quickly through the capital budget? Post-COVID environment, what do those priorities and reprioritizations look like? Second theme is going to be tactics. When you go to the market, how are you going to the market? Many of the things that we've heard about already here, changes in sizing strategies, maybe changes in coupon strategies, changes in timing of when to go to the market, short-term versus longer-term borrowing, particularly in the face of having to spend a lot of money before the federal reimbursement can happen. Those are all changes in terms of tactics, and so we'll explore that a bit. And then the third part we want to explore is disclosure, particularly around changing disclosure needs as investors are trying to navigate themselves what's going on in this market, as well as a lot of the concerns that COVID has really highlighted lately with respect to things like climate risk, with respect to concerns around inequity and the need to be investing in underinvested communities, so on and so forth. Those are all what we'll call disclosure priorities. Now, these categories aren't mutually exclusive. I'm sure there will be some crossover across all three of them, but we wanted to kind of organize our discussion that way. And again, hopefully have some time at the end for lots of conversation with the audience. So again, going back to the first theme that we want to explore today is priorities. And for that, fortunately, Uri has volunteered or perhaps been voluntold to go first. So we'll turn to him first and see where we go from there. So welcome all of you. Look forward to hearing what you have to say.
Thank you, and good afternoon, everybody. I think from our perspective, the priorities have shifted in interesting ways. And for anyone who reads the papers, Philadelphia and its facilities have long been a challenge, particularly with environmental issues. I think that's where the priority has changed a bit, where it used to be repair and remediation of asbestos, lead paint, and those types of capital issues, which were smaller, more contained. There's really a focus more on replace rather than repair, with a particular focus on ventilation. COVID has raised those concerns in unbelievable ways. Philly schools have an average age of 70-year-old buildings, several over 120 years. So you can't do the same kind of asbestos, asbestos remediation is one thing, but to really deal with ventilation, HVAC issues, air conditioning are much larger and really replacing buildings. So I think bigger projects in a lot of ways, and obviously speed. It's a national issue about getting kids back into schools, and we know that younger kids can't get vaccinated. So how fast can we do things? How fast can we deal with ventilation on both a short term to get kids back in with a look at medium term and long term replacement, but no one wants a 20-year, 30-year time frame. They want 2, 3, 5 years to get as much done as possible. So I think that's been a real shift for us, both in terms of scope and speed.
Terrific. Lakshmi, priorities.
Good afternoon. Thanks for this opportunity. Very happy to be here. With the city of San Diego, we are 1.4 million in population and the second largest city in California. Very large capital improvement program, including the ongoing appropriations. And during the COVID, continued investment totaling about $2 billion. So that is the, breadth of the capital investment in the communities. Interestingly, within the $2 billion program, prior to COVID, although the themes continue, anchors were the very large, pure water program, purified water, having independent, water supply to San Diego, which was about $1.2 billion program, receiving federal funds, not to mention, of course, city actively in the tax-exempt markets, both for short-term and long-term needs for this program. And then, of course, the stormwater program, compliance-driven stormwater system, reducing pollutants in the urban runoff, and state and federal, regulations are fairly stringent, and in that regard, intense capital investment has to occur. Then, with the COVID, interestingly, and an important shift, while programmatically, all these themes will continue, is the city's renewed focus on climate equity matters. With respect to what I mean by climate equity is, which is defined in the context of the city's climate action plan as environmental justice and social equity. So that has taken, significant, front stage in the operational as well as capital programs. What does that investment look like in the capital program with respect to these climate projects? Make buildings more energy efficient, shift San Diego to cleaner energy, boosting alternate forms of transportation and increasing recycling, whether it is voluntary or mandated in the state of California. And, with respect to equity that took various forms, including, libraries equity, parks equity, tree canopy equity, digital equity. Is there Wi-Fi, access to all the communities? And the answer is no. So, the previous panel discussed about taxable markets, and most of these newer components of the capital program, time will tell, will the traditional tools in the tax-exempt markets would fit into these needs. And another important area that is, across the state, including City of San Diego, is housing solutions to the disadvantaged communities, where services are an important component. As we all know, tax-exempt markets traditionally are in the space of traditional brick and mortar, space, is providing broadband access, which generally falls in the services category, versus brick and mortar with a long asset life. These are, important issues, challenges is planting 1,000 trees in the city? And is that a traditional tax exempt use? These are all important issues currently city is evaluating. Thank you.
Wonderful, thank you. Manju, mind telling us about priorities in the Commonwealth of Virginia? I think you're on mute.
Thank you for inviting me to be on this discussion, and hello to all my fellow panelists. Nice to meet you virtually. So as I talk about the Commonwealth of Virginia and capital funding needs and what we see going forward, let me give you a little bit of context. So Commonwealth is 8.3 million people. We have a budget of $24 billion that's supported by general funds, tax-supported budget, and another 42 billion or so non-general funds for a total of $67 to $68 billion budget. So a large Commonwealth with 120,000 employees. Going into the COVID timeframe back the first 9 months of fiscal year 20, which was through February, March, the Commonwealth was growing at its revenues were coming in very strong. We were projected to grow at a rate of something like a little under 3%, but our cumulative growth rate going into the COVID time was approximately 6.5%, so more than twice what we had projected. That put us in a very strong position going into the last quarter of COVID when March, April, May, June, hit. And we experienced, the revenue started to decline and unemployment started to rise up. We thought we'd have a deficit of $1 billion or so, but we ended up with a deficit of $234 million, which was just 1% of our general fund budget. And it was two factors: that we had strong growth that helped mitigate the deficit, and many states did something that Virginia did not do. As you may recall, the federal government extended the tax filing deadline to July 15th, and many states kind of matched that and allowed their citizens to file state taxes on or after July 15th as well, which presented problems to many states because it crossed fiscal years. And because it was crossing fiscal years, Virginia, although we did extend the filing deadline from May 1 to June 15th, we didn't go beyond our fiscal year. That was another reason that we were able to contain our deficit to a much smaller number. So because we were strong financially going into COVID, and as COVID was taking place, we really did not have to reprioritize our capital spending. All the capital spending that was programmed continued. We have approximately $5 billion worth of authorizations that have been authorized by previous legislature for which the bonds are yet to be issued. Our legislature authorizes spending and bond financing, and they might authorize $1 billion last year, $2 billion next year, but we issue bonds on cash flow basis when cash flow is needed for the project. So we really didn't have to, cancel any projects. I think we saw something opposite. Our universities, they get majority of the capital funds that are tax-supported capital spending that occurs. And they went on a high gear because the students weren't there, campuses weren't open. They were taking advantage of the time frame to accelerate and focus on their capital projects, oftentimes which might get delayed because they don't have time to do things sequentially as quickly as possible. So we saw a lot of outflow and had to go to markets quite frequently to keep up with the cash flow needs. The Commonwealth issues debt through a different debt issuing authorities. The Virginia Public Building Authority and Virginia College Building Authority are two major authorities that we issue debt through. So the business of debt financing and capital project construction, we saw really no changes, and we were fortunate in that sense.
Interesting. So anyone who's watching who happens to be a state of Virginia income taxpayer, if they were unaware, now they're fully aware that they did not get an extension, and they probably need to do something about that right away. Very interesting. Thank you. And then last but not least, Dwight, tell us about priorities from the transit perspective.
Sure, Justin. Just as just about every transit agency in the country was impacted significantly by COVID, DART in the Dallas area was also impacted significantly. However, the impact did not lead to a change in the prioritization of our capital projects. Our main short-term large capital project we were just breaking ground on before COVID hit was a 27-mile new commuter rail in the northern sector of our service area, and that continues. As a matter of fact, we have although we've seen experienced some delay because of COVID and some cost increases, the commitment from our board and our ability to continue the financing program for that project has continued. Just to back up a little bit and just to give a perspective about my agency service area, we also, similar to San Diego, we have a 1.2 million population service area. And in addition to the city of Dallas, DART also covers 12 other cities in one of the fastest growing areas of this metroplex. And one of the key strengths that we have here is the size of our sales tax base. Our sales tax base makes up about 70% of our total operating revenues each year. And we are the third largest local sales tax base in the state of Texas. So with over $600 million annual sales tax revenues for the year. And while COVID did put a dent in our sales tax collections, the dent was much more minor than we had anticipated and than we had budgeted for in the midst of COVID. And we basically came out of COVID really only having experienced a sales tax drop of about 2% year over year. And just as other places are seeing this year with the recovery, our sales tax is coming back with gangbusters. We're seeing sales tax numbers for the last 3 months, of course, more than we experienced last year. That's to be anticipated. But now we're seeing sales tax returns higher than before COVID, record-breaking numbers, as a matter of fact. So this treasurer is happy with regard to the revenue stream. The commuter rail project that I just told you about, we also got some really significant assistance from the U.S. Department of Transportation. They awarded us a $908 million loan from their so-called RIF program, the Railroad Rehabilitation and Improvement Program, with a really favorable interest rate. But even more than that, during COVID, they really helped us out by offering to refinance that loan at a lower rate, at the prevailing rate that's tied to the 30-year Treasury rate. So we were able, in the midst of COVID, to actually go back to the U.S. Department of Transportation and get a refinancing that saved us a substantial amount of future debt service for that $1 billion plus commuter rail project we're doing. Longer term, the impacts of the permanent structural changes that might be caused by COVID in terms of like commuting patterns to the central business district and the use of buses and where our ridership will land permanently. Well, that's still an open question. And so we'll have to wait. And our policymakers are going to wait and see what long-term impact that has on us. But so far, we are really fortunate, I think, with regard to our sales tax revenue stream from the continuing support that we're getting from, for example, from the federal government with COVID relief funds. We've got breathing room to be able to figure out our way forward.
Terrific. Great to hear. Anything anyone wants to add on priorities, real quick? That's great answers and clearly some common themes there. And I'm sure we can come back to a few of those a little bit later. Okay, well, with that, then let's go on to our second piece, which is tactics. When you go to the market, how are you going to the market? And is it different from when you went to the market pre-COVID? One thing, if possible, it'd be great if you could speak to, has been a theme all morning, and that's the role of taxable issuances and the potential value of taxable issuances to your jurisdictions. So when you go to the market, what's different? And maybe for this one, if Manju wouldn't mind starting, that'd be great. I think you're muted.
COVID did force us to make some changes to our normal issuance strategies. However, we see these deviations as temporary and not likely to continue much longer once we are back to our new normal and go back to our standard practices. So let me kind of talk about how we typically issue our debt and then, what changes did we have to make. So Virginia typically issues debt for 20 years period. Our duration for most of the projects is 20 years. Some bonds are issued for 30 years if it's transportation related or Virginia port related, or some being issued on behalf of some pool issuers. But generally, for most projects, we choose the 20-year issuance schedule. And the debt is typically amortized in a level debt service basis over that 20-year period, except for our general obligation bonds. Our Constitution requires us to have level principal payments for general obligation bonds. And we normally, because we are a AAA rated state, we have found that going to the market competitively works the best for us. We always have anywhere between 10 to 12 bidders on any time we enter the market. So we tend to do more competitive bids, very rarely do a negotiated bid. However, when COVID first hit in March, we had a $500 million deal lined up to go to the market late March, I believe it was. And then suddenly mid-March, we got the notification from our governor. We are going into an emergency. Everybody's closing down. Everybody go remote. Nobody come back to their buildings. And the markets, if you may recall, were just became very, the markets froze for several weeks. There was a lot of, volatility in the market at that time. So we kind of pulled back that deal for a few weeks, and my staff and team then quickly pivoted to convert that competitive deal because it was $500 million, large amount. Our advisors said it would be best to go on a negotiated basis because even in April, the market was still volatile and it wasn't completely back to normal. So within a matter of 3 weeks, we went from doing a competitive deal to, procuring or putting together a consortium of underwriters and issuing our POS the day before and going to the market next day on a negotiated bid. We did okay. All right, even though the market was slightly volatile, we came out doing all right. So we did another, following that deal, we had another deal for $650 million for our Virginia colleges and universities. And that too, we decided to do, that was in June, we decided to go negotiate it on that. Both of those deals, I think the Virginia College Building Authority deal, we had a TIC of 2.5%. And on the other deal, it was somewhere around the 2% too on the new money bonds. No, sorry, on the Virginia College Building Authority, we actually got 1.86%. 340 million of that was new money. And on the one that we did in April, we had 2.5% on the new money bonds. So again, while taxable rates are low, Virginia generally doesn't do refinancing unless we see that there is money, there are savings in there. So we have been doing taxable refinancing because the taxable rates are so low. In the last couple of years, especially since pandemic, that many of our deals, that bonds that were issued a few years ago or 5 years ago are still, coming out despite having to do escrows and everything else that we can save money. We've been doing that. We've analyzed shorter calls and have done some deals with shorter calls in the past, but really that hasn't worked for us. So we're sticking more to the 10-year call period. The one area where we had to make most changes in our issuing tactics was the higher ed sector. The universities and colleges, as you might imagine, was one area of state government that was hit the hardest, with the students not coming back to campus, no dorm fees, no dining fees. And our universities finance a lot of these projects that are revenue backed, dorm and dining projects, recreational facilities, athletic facilities. These are all based on fees and revenue they generate. As a result, they really needed help. And in order to help them, we worked with the governor's office, the treasurer's office, worked with the legislature to get special permission to do some restructuring. Because Virginia is very conservative, we hardly ever do in our refinancing. It's very vanilla refinancings, just to do the savings and not extend the debt duration. But here, to really provide them some debt relief, we would have to do restructuring where we would be extending their debt durations and tacking on extending the duration. So we had to go to the legislature and seek some legislative authority to do that for general obligation bonds. Although we had the authority to do for bonds that don't have the general obligation pledge behind it. So some of the bonds that Virginia issues, we refer to them appropriation-backed bond. We don't put GO pledge on all the bonds we issue. But some of the university bonds were GO bonds. And once the General Assembly passed that legislation back in this past January, we were able to go to the market. And what we did was the scoop and toss restructuring, where we took the first 2 years of debt service payments and tacked them on to and extended them by 2 years on project basis. So it was a very complicated financing because we don't issue debt on project by project basis generally. We issue in a pool for a basket of projects and then provide the cash as those projects need them. So we had to do that for our higher ed sector. So as a result, we were able to provide, tax relief to them. Debt service relief, combined debt service relief of almost close to $90 million in year one and year two, collectively to our higher education institutions. There were 13 universities part of that initiative. We also tried one other thing that we had planned on trying in 2020 was the electronic bidding platform. Vendors had come to us in the past like, hey, you should try this. And I was curious to try that. But in 2020, with the way the market was, we put it off. But we tried it in this past spring for our notes. We issue some 5-year notes for our school K-12 schools. And these notes help school divisions finance their IT needs and their information security needs. So it's $60 million over a 5-year period. We gave it a try, and that was interesting. It went well, and we issued $60 million at 0.32%. So those were some of the changes that we made in our tactics on how we go to the market.
Excellent overview. Thank you very much.
Mm-hmm.
So left to right on my screen would mean that Lakshmi's next.
Thank you. We were in the markets very actively during the last 12 to 18 months. I suppose, that's, gave us a crash course on how to adapt to the ever-changing landscape, which it was, starting with April of 2020. And city, I was just aggregating, what are the categories of, instruments that we were in the markets for. Of course, city has, a diverse set of credits that may be essential utilities. These are all the things that we were in the markets for, short-term, long-term, general fund, water utility, and Lucky Us Convention Center. That in itself was an interesting, dynamic going into the markets where there is major dependency for the city, obviously, as a tourist destination. So as to the bond financing efforts, of course, all these are very successful offerings. And with the short-term paper, clearly, as with my colleagues, if you are in the short-term space, March and April, where a significant, there were concerns whether is there market access or what are the rates that are especially rollover paper will be set at. And so there was active management on the city's part, to the extent there is a flexibility to sit in the sidelines, week by week. That's an important consideration, especially in mid-March through early April. And also, we were able to, observe the considerations given by the underwriting community. City, because of our long-term bonds activity, close to 6 bond offerings within that taxable advance refundings, the interest rates were still favorable, especially after the federal intervention, and there was, market has settled, continue to be favorable, past the credit concerns, that the investors and our credit rating agencies, have taken into account. So in that regard, great outcomes with respect to call options, 10-year calls, and split couponing has occurred, while the earlier papers this morning have discussed about institutional investors' preferences versus retail. And of course, it goes without saying, as a AA agency with all these credits still maintaining stable outlooks in March, April, May time period last year when the city was in the markets, our job as stewards of the local government is to get the best rates possible. So there was, clearly from staff standpoint, as well as, working closely with the municipal advisors and underwriters to ensure that while the city's interests protected in the structuring space, equally able to see the shifts in the market during that period, and so be cognizant and work together in finding the optimal structuring elements. So there was split coupons adopted, 5% some places, most of the places obviously on the curve, and likewise 4 and 4.5% as well. And city has been, in second week of April last year, of course, the very first time, perhaps, in the Zoom interactions in setting the prices. And that is some adjustment to even major, investment banks. Regulatory, they have to, have in-house exceptions to have the trading activity, interfaced in this virtual space. But end of the day, San Diego had great results, and especially in the context of while the city was not in the ESG, space, clearly many of the uses fell indirectly in that spectrum. So there is a lot of active interest, from the investors in the context of especially general fund credit. We were there for the lease revenue bonds, and we were there for water utility. It's a meshing with with respect to the COVID. In the case of general fund, how are the finances? What is the tax collections or not? Was there a deferral, of property tax collections or such, or draws on the reserves or not? So these are important, inquiries that the takeaway is more than ever. It's important that the issuers, and of course, speaking for the city, realize that in active engagement by the issuer, and coordinating with the market players on every transaction, of course, led to, a good result, given that the market was, as Manju said, quite volatile and in flux. Thank you.
Thank you. Ulrich, can you tell us about tactics in Philadelphia?
Sure. So COVID hit at a very interesting time for us in our recent borrowing history. Philadelphia School District had been having financial difficulties and really had very little access to capital markets. 2015, 2016, we're spending $30 million a year on capital, and we should have been spending 8 to 10 times that. And we've been improving our finances since then, and actually about 2018 got an investment grade rating for the first time since 1977. As I said, we kind of hit a sweet spot in that we were investment grade, but because of our rating, we're also a decent yield at a time of low yield. So made us rather popular out in the market, which was nice. And on the theory of better lucky than good, we actually did the largest borrowing in the district's history, November of 2019. So timing is everything. And that was about a $500 million. We did a $500 million borrowing plus a $30 million green bond. And I think the biggest issues for us as we look at tactics are, interestingly enough, not that I want to say that there was a positive side to COVID, but one of the advantages we did have is while students were out of the buildings, we were able to do more work in a year than we normally could have. So where we would normally spend $100, $150 million, the majority of the work in the summer, we spent over $250 million during the last fiscal year. So how we think about our ability to spend the funds, we did our first full turnkey for a new school building, which we hadn't done in the past. So that thinking about in terms of cash flow on a bond and a one-time payment for a building of $80 million as opposed to regular flow, and how we think about sizing of a deal is really important. I think the two issues, I'll say sizing in particular, because we've committed to about a third of our Recovery Act funds, so over $300 million going towards facilities. So looking at that as a piece in our capital spending toolkit, how that works with what we'll borrow, and obviously timing issues. And in terms of the taxable, non-taxable, again, because our last deal was 12 times oversold in terms of offers, and we have that nice spot in the market. Might there be an advantage to taxables as we look into our next issuance is going to be in the fall. So we're keeping on our schedule, but the flexibilities from taxables, in addition to kind of a different place in the marketplace in terms of how we spend it, what we can do with the money while we're balancing spending the federal money and the time period that it has to be spent, along with having flexibility with the capital money we borrow this way, has kind of created new wrinkles for us, which is a positive. I mean, how we can take advantage of them. So it's changing some of the strategies. And then the only thing I add is we spent a lot of time, the debt portfolio was a little interesting. When I started the district 5 or 6 years ago, a lot of backloaded deals and things like that. And we spent a lot of time, it's very vanilla, which I'm very happy about. But it gives us an opportunity to really look carefully at where our gaps are over the long term, how we can best take advantage of what's going on in the market. Again, taxable, non-taxable, but all those are kind of on the table as we think about, we know what we have to do, how we want to do it, and what can best fit those priorities, and let the funding schemes match what the capital priorities are.
Wonderful. Very interesting. Dwight, I wonder if you had a similar opportunity. No one riding the trains, did that give you a chance to work on the trains at times you might not otherwise be able to.
Well, definitely, and gave us also an opportunity to do some improvements to our infrastructure. But so yes, it did. Okay, so before I talk about DART debt over the last year or two, I have to speak to something that Manju just said about the Commonwealth. And she spoke proudly about the AAAs that the Commonwealth carries. Well, I spent 8 years in the early 2000s at Moody's as an analyst, and I remember actually being in rating committee voting on the Commonwealth credit rating. So you're welcome. No, no, because it's a well-run state. My experience with issuing debt during the time of COVID was really dramatic. I was actually in New York pricing a series of bonds in March of 2020 on the very day that the markets started shutting down, that the city of New York started shutting down because of COVID in the middle of our bond sale. And so our bond traders were number one, they were worried about themselves, right? But they're trying to get the work, so they rolled up their sleeves, trying to get the deal done, and we're chasing the buy-siders, the investors, trying to find them to purchase the bonds while they're trying to leave Manhattan. So it was quite a dramatic. I've gone through a lot of bond sales in my career, but that was the most interesting one. The sale was successful, but it was a really eerie flight back home to Dallas when I've never had a flight back from Manhattan that was empty like that in a plane. So it was a really, really interesting time. Speaking of that bond sale, that kind of goes, Justin, to your other point, is how we're structuring things these days. Of course, that sale was not impacted by the COVID, but was impacted by, of course, the inability to advance refund, on a tax exempt basis. So we had almost a $300 million deal. About a third of it was taxable. And so we split the deal into a tax exempt portion and taxable portion, and it was a negotiated sale. So we decided to split the syndicate into two and allow until one team to focus on the investor base that was more interested in the taxable debt, and another syndicate on the tax exempt debt. So we spent one day with the headquarters of the book runner who was running the tax exempt deal, and the next day, the really interesting day of that COVID kicked off, in the actually on Wall Street pricing bonds with one of the other deals. And since then, we did one more taxable deal later in 2020. It was successful, but it was unlike Uri, it was not 14 times oversubscribed. I'll just say it like that. We had to work on that deal to get it done, but our credit's great. Like I always tell my old ex colleagues at Moody's, I said, this is a sales tax deal. This deserves high rating. I always tell that they have a AA2 on my rating right now. S&P has AA+, Crow has a AAA, and so I tell my friends at Moody's that you are like usual underrating my bonds. So we continue in terms of couponing. Well, it's back during the times, if any of y'all have been around since the previous economic downturn, when the Build America bonds were issued. From way back then, when I was issuing debt, I insisted that we put a 10-year call on the deal, even though it was taxable, and that was a new thing back then, right? To put a 10-year call on a taxable deal. But in talking to our municipal advisors, we're like, this is muni debt, and muni debt is accustomed to 10-year call. So just as we didn't have a problem back then, we didn't have a problem putting a 10-year call with with related structuring and couponing on it with the deals we've done since then. So keep our fingers crossed that perhaps Congress may come around and let us do tax exempt advance refundings again, but I won't hold my breath on that. And we'll just have to keep doing what we do.
Makes good sense. Good sense. Thank you. Okay, well then let's go into our third piece with the time we have remaining, and leave a little bit of time for some questions here at the end. I know there's a few. Maybe we can start with Lakshmi on this one. But the third piece, of course, is disclosure. We've certainly heard about issuers on the market who have gone to more structured, more sophisticated investor relations programs and are doing a lot more in terms of outreach and proactive disclosure, financial disclosure, and otherwise. And certainly with all the emphasis these days on climate risk and lots of emphasis, as has been touched on before, about more information about climate risk and ESG more generally. How is that hitting all of you? Talk a little bit about the disclosure environment you're in, and anything different you're doing with respect to disclosure in this post-COVID world. Lakshmi, go ahead.
Right. So the fact that in the previous topic we have covered, we were in the markets of a variety of credits, approximately $1.5 billion, investment is what, through the debt markets, whether it is long-term bonds or short-term paper or federal loans. So we have seen, of course, by being in the primary markets, of course, as an issuer, developing the primary offerings statements with these, topics that Justin, you have just mentioned. COVID disclosures, of course, right and center for all these credits. Of course, mostly the general fund credits, which we were in the markets, and general fund, credits, the emphasis on, loss of revenue base in the case of the city. Would there be an impact on property tax base? Would there be an impact on sales tax generation? And importantly, for San Diego, on the transient occupancy taxes on the lodgings. And of course, SEC's guidance early on in April, May timeframe, providing some leadership in issuers where we're all in the dark as to how are the revenues going to trend in our case. And is there any federal support, or in the case of FEMA's assistance? And how do you prepare these disclosures? Of course, there is a worst case scenario that can be built, but also, with so many, moving parts telling our story, SEC's suggestion that good faith effort on the part of the issuers, tell what we know, at the moment, that definitely, put to rest some unease. We don't know what we don't know. And that, led to, of course, from a credit evaluation standpoint, what are our liquidity levels? Is there sufficient cash flow to run the, daily operations? And in the case of reserves, of course, reserves are meant to be rainy day reserves. And as the former mayor was quoted, well, this is hurricane season. The rainy day reserves are meant for this. And in the case of the city, city was one of the few large cities with the 500,000 and above population has, in the very initial round of CARES Act, benefited with over $300 million in influx in, direct expenditures related to COVID and public health. So these are the disclosures that took center stage that was not, of course, there before. And then moving on to all things related to climate change and the risks that are offered in that space. And, comes to mind last year, the California Debt and Investment Advisory Commission put out a report and analysis, data analysis, albeit with respect to enterprise issuers, suggests that there is a growing awareness, a shift even starting 2019. The larger the issuers and more frequent the issuers are going to the market, there is clearly a recognition that it's important to recognize all things related to climate change and how it is affecting the operations, the finances, and the risks for the investors. Whether in the case of City of San Diego, the sea levels rising and/or coastal erosion, cliffs and bluffs, becoming a daily event. And some observers say 2020 calendar year was the worst of the wildfire season in California. And a lot of active management on the part of the city, and with some luck, we did not have to face, significant wildfire loss in the Southern California region. And finally, is it because of the COVID or in general, the trends in disclosures with respect to cybersecurity and information technology? And while it is a growing need in the ESG space, communications and as we previously touched on, digital equity, city becoming all things to all people, but at the same time exposing itself, to security measures and how it affects the finances, which of course is an important disclosure issue that, responsibility falls on the city to convey in these disclosures. And finally, goes without saying, the private debt, whether it's bank loans and or financial obligations, which is the SEC's definition for the previously coined bank loans. And as one issuer here, agree that bank loans and the risks associated with exposure there in the bank loans, and therefore the duty to disclose all that. And would like to note that, with the growing interest among the investors for in ESG, topic, all things related to that, and the risks and the climate change and all that, city very recently took the opportunity to make, while these are not investor materials, recognizing the important need to communicate, transmit, be transparent, availing the Msrbs EMMA page, and recently posted all our included in the primary offering disclosures, but importantly on the issuer investor page dedicated for ESG and sustainability materials on EMMA. So this is all, clear recognition is there. There are, new disclosure topics for those issuers that are in the market, such as the city, as well as, those important disclosures that are the backbone for the city to, take our, borrowing needs to the markets.
Very interesting. Very interesting. Yeah, this one will go right to left on my screen. So that would mean Dwight's next.
Thanks, Justin. With regard to disclosure, we really have not made any significant changes to our policy with regard to disclosure since COVID. We have, of course, just made sure that during our normal disclosures, in our bond packages, and our quarterly disclosure statements, we do quarterly disclosure here. It goes back to the days when we needed to provide. We were a newer trans agency and needed to provide assurance to the buy side because of our sales tax stream. But we still do that to this day. It's really frequent and updated, detailed disclosure. So any contingent factors that pop up, including COVID, we just make sure that we include that, just like everybody else does. One of the most interesting things for us, longer term, with regard to disclosure, is how much detail. This is a question we're asking ourselves: how much detail about ESG, about sustainability, about about it. Any efforts to attract that portion of the investor base that is geared towards sustainability, green bonds, things like that. That's still a question for us as to how much effort do we need to put into our offering documents to try to bring in that sector of the market. I'm still not convinced that if I slap a green bond designation on my OS, is it going to move the needle when it comes to our TIC? And just haven't seen that yet. And so that means that the more effort, and especially for this cheap treasurer, the more money I have to spend to try to get some the designation, it's like, where's my return on it? You know, in terms of ESG. Everything we do here at a transit agency is anytime we sell a bond is going to be sustainable. I mean, it's going to add to sustainability. It's going to be adding to getting cars off the road. It's going to be green. It's going to be moving towards year by year towards using less and less fossil fuel. So we are all about sustainability. So it's just how much effort do we put into our disclosure to actually prove the obvious to the markets, and what does it do for us? That's an ongoing question. But most importantly for the buy side is to make sure that for every disclosure that we're transparent, that we identify issues and challenges before the buy side does, because they're gonna already know what our challenges are anyway. So it's good for us to make sure that we're on top of it. And that's it, Justin.
Yeah, makes good sense. Makes good sense. And one of the running themes of this conference over the years has been the slapping the ESG or green bonds label on things and how the market responds versus doing very different kinds of borrowings for very new projects. And that's certainly an ongoing conversation everywhere in the market. It's very interesting to hear your experience with that. Just a couple of minutes left. Uri, anything you want to add on disclosure from your vantage?
Just a few quick things. So again, I think partially because of our troubled history on the markets, I think we had very robust disclosure to build up trust. I do think one issue that's interesting, which flows through some of the disclosures, is that we can all go through and say we've just had the ultimate stress test and we've all survived, which I think is a really important post-COVID. We looked at our systems, what could have happened to our financing, and I think the fact that we had a really good story, we had built up the reserve, but used the reserve the way it was meant to be used, that financing came back, that the state stepped in when they should, the Fed stepped in, is a really good story, which lends into the disclosures as well. I agree with it was Lakshmi about cybersecurity is becoming a growing issue, which is separate from COVID, but just how you deal with that is fascinating to me. And just one comment on the green bonds. So I agree with Dwight completely that haven't seen the value in the market for us in terms of that return in the market per se. But so we have been doing a lot of Giza energy projects, ESCO energy projects as ways to do some of our facilities repair, because so much of it is environmental and HVAC related type things. Because those projects were being done in a discrete way and already have the measures that green bonds are looking for, we focused the green bonds on those, separated them out from our regular capital issuances, which made our disclosure requirements and reporting requirements much easier because we had to do them anyway as part of the energy projects. And although didn't see the value in the market we'd hoped, the public opinion value, the value from our funders, from the city and the state, is sky high. So the value where that pays off there, where they'll brag about it, we can brag about it, has real value to us. And because it's not costing us on the disclosure side, it's actually been a real strong approach for us. And as we look forward to an issuance in the fall, we're probably going to follow the same model with a larger general capital, but also a Giza-focused green bond issuance.
Very interesting. Yeah, great point about the intangible value, the optics value, so to speak. Hard to put a dollar value on that, but it is real for sure. Manju, let me give you the last word on disclosure.
All right. Well, quickly, not a whole lot of change, but one thing Virginia did do was establish a dedicated investor website in 2018 through the BondLink platform, virginiabonds.com. So that has allowed us through COVID to post all our information on our dedicated investor website. But of course, we continue to post on our annual report and certain financial and economic data as it becomes available throughout the year. I believe in as much transparency with investors and, provide more rather than less. During COVID last year, in June, we went out with a COVID disclosure, interim disclosure, and then updated that in December just to kind of let the investors know what was happening to Virginia and its revenue and what measures was our governor taking to contain the COVID spread. Now with vaccinations, we've started to include vaccine status too in Virginia, which I'm glad to say we're one of those states that has 70% of adults vaccinated or at least one shot. With regards to two things, cybersecurity and ESG, I know rating agencies are focusing more and more on that and getting information from issuers on that. We haven't included in any formal fashion in our disclosures those two areas, but we are internally discussing as to how best to incorporate that and look to doing that in our future issuances. That's it. Thank you.
Wonderful. Well, I think we've been able to speak to the few questions that have come in from the audience in the conversation that we've had. Certainly lots of curiosity about the surge in taxable issuance, the potential for BABs, many of the things that we've spoken to here already. So I think we've done a nice job of making the points that we plan to make, as well as responding to some of the audience questions. So thank you all so much for that. It's been a real pleasure. I appreciate all of you taking the time, and you certainly gave us a lot to think about and brought to life a lot of the research questions that have been kicked around here at the conference. So thank you all, particularly to those of you taking the time on, given the where we're at in the market and given where we're at with Zoom meetings and everything else. I appreciate all of that. So with that, I think we're good for today, although I want to hand it back to David Wessel for any wrap up.
Thank you very much, Justin. And I really want to thank you in particular. 4 hours of moderating on Zoom is heroic. You deserve something. Maybe we'll get you a municipal bond paper certificate painted in green to celebrate. I also want to thank the panelists and, of course, the authors who presented earlier today. For our audience, we're going to resume at 11:30 tomorrow with a discussion of papers on financing infrastructure. And then at 1:30 tomorrow afternoon, we're going to have some breakout sessions open to anybody. Zoom links are on our website, one on what's going on in the state and local sector, and the other on what's going on in the muni bond market, including the interesting developments about Build America bonds and advanced refunding and all that. So with that, thank you again. And I also want to thank the Brookings staff, Stephanie Sensula and Hao-En Chen, who've helped make this day a virtual success. As you know, these things are never bug-free. Today went pretty smoothly, and where there were bugs, they stepped in, and I appreciate that. So with that, have a good afternoon, and see you tomorrow.